the Fed and Powell in particular needs to get across the message that the job is not yet done.
It's not just about what the ECB does and what the Fed does. You have to take into account the market's inflation premium.
We're really playing a game where the market desperately wants the Fed to react.
We are still very much in the early days of recovering off of an extreme low.
Right now, central banks everywhere will take anything they can get.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
This economic data is not pretty. From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures positive 1/3% on the S&P. TK, that data out of Europe, ugly.
Well, the data out of Europe's ugly. It's ugly everywhere, John. It's going to be interesting to see the data as Chairman Powell waltzes to Jackson Hole. What I would suggest, John, is after the difficulties yesterday, down over 600 points, what we see this morning in foreign exchange, John, can you imagine his speech if we get Monday, Tuesday, Wednesday, Thursday of this kind of market action?
And then clearly it changes, Tom, because what we've seen over the last month or so is an easing of financial conditions. They've certainly tightened up over the last couple of days, and we're seeing real weakness abroad, not just in Europe, in China too.
Well,
here's the quote off the back of the European data. The data points to an economy in contraction during the third quarter. Tom, that's what we're all looking for in the European economy.
I would agree, and I like the idea that you devolve down to what is economic growth doing, because that to me is the end result of all this, and we'll address this. Jan Hatzius with us here from Goldman Sachs coming up. But John, to me, the number one thing right now is away from the strategists and all that. It's trying to get a handle on the interdependencies of these global economies. What does Governor Bailey say to Chairman Powell at Jackson Hole?
Governor Bailey staring down the barrel of a real slowdown. Bramo, did you see that data this morning? The manufacturing PMI in the UK, brutal.
Stagnation over there. In the euro, they're just sliding toward a recession. That's the view from Bloomberg Economics. The UK is already in stagnation, and the recession is inevitable. The question really is just how deep. Hiking into pain. And really, I got to reiterate what Tom was saying. The issue is how much can the U.S. continue to diverge? How far can it go as you do see all of this pain trickling out in European data?
Can it decouple? What do you make of the market move? 2 days, down 3.4% over the last 2 days on the S&P.
The bulls are getting more entrenched. The bears are getting more entrenched.
There
and that's,
we go.
I mean, honestly, that's my takeaway. You read the notes. The bears are saying,
Look,
this is clearly a bear market rally. The bulls are saying, we've already seen the bottom. This is a time to pick up things on the margins. And you have not seen really a shift
John,
in the two camps.
The theme here is Chairman Powell. I mean, the shock of Chairman Powell pivoting or suggesting pivot light at Jackson Hole would be like the same as Man U beating Liverpool. It's unthinkable.
Unthinkable, but it happened, Tom. I think there's more chance that Manchester United win the next game that Chairman Powell's going to pivot later this week.
That could be.
He never really did pivot. Let's put it that way. I think at the end of the day, what people are looking for here, Lisa, they're looking for a shift lower from a 75 down to a 50 to a 25 and hopefully a pause. And then the market's looking at cuts next year. And that's the big difference between the market and this Federal Reserve. A market that's looking for cuts next year and a Federal Reserve that's talking about raise and hold.
Okay, but here's my favorite part about markets. Everyone's anticipating a hawkish message from Fed Chair Jay Powell, and they're lining up their bets in anticipation of a hawkish discussion on Friday at 10 a.m. At what point do we then get a buy the rumor, sell the news kind of activity when he actually comes out, even if he's hawkish? I mean, this just is the mind-spinning aspect of markets.
Daddy went away for summer, the kids were playing games, and then he's going to come back after a long summer and do a speech. So, Bramo, they're clearly cleaning things up.
The kids playing games.
You tidy the house, don't you?
Is that us for going on vacation?
Or it's market participants, like toddlers sometimes. Futures positive 1/4% this morning on the S&P. On the NASDAQ 100, up 37, up 1/3%. We bounced back a little bit after 2 days of ugly losses. Yields higher by not even a basis point, through 3% in the last 24 hours on a 10-year, 3.0165%. And maybe, Lisa, we need to get used to this. Euro dollar breaking through parity.
You know, I find this fascinating because we did see that breakthrough parity actually closing below parity for the first time going back to 2002. It is solidly there. We have reached that level and we are not going back, and that seems to be the direction of travel. Okay, so talking about the European PMIs, we do get a series of S&P PMIs from the United States at 9:45 a.m. At 10 a.m., we get U.S. July new home sales. I'm actually more interested in the new home sales because in the United States, I'm less interested in the real-time deterioration in manufacturing manufacturing and services than I am in how much the housing market is rolling over. How horrific is it or not? As we see the volumes really tick down. We have seen an incredible tick down in the volume of number of transactions. At what point does that translate into lower costs, lower confidence, the whole sentiment, a read through of lower prices of mainstays in investment portfolios? At 1 p.m., we get the U.S. selling $44 billion of two-year notes. This, to me, is actually a particularly interesting auction given the positioning. Hedge funds shorting the front end at the fastest pace on record, according to some measures, ahead of the expected hawkish speech on Friday from Fed Chair Jay Powell. And today, this is the tail end of earnings season. The vast majority of U.S. companies have reported. However, we get the latest read on the consumer. Macy's is reporting any minute now. Dick's Sporting Goods is at some point this morning, as well as Nordstrom after the bell. At what point do we get some sort of read, John, on the consumer versus idiosyncratic stories? If you take a look year to date, they have been incredibly divergent, these retailers, in terms of their fortunes. How much do you see an ongoing divergence versus a cohesive message about how much momentum consumers can really have at a time of such high inflation?
Lisa, thank you. Can I just say the chart of that 2 year is just ridiculous.
It's ridiculous,
Every
right?
time I see it. Every time I see it. Lisa, thank you.
Agree.
For much of the last 10 years, when you get this gloomy data and things start to look bad and the market sells off, I'd catch up with Steve Orth, the Federated, and Steve would turn around and say, just buy it, John, get a grip, it's not that bad, just buy it. And it turned out to be okay, and buying it was the right thing to do. Steve Orth is not saying that anymore. The Chief Investment Officer for Equities of Federated Hermes joins us right now. Steve, you're not saying that anymore. Walk me through it. Why you're so defensive this time around?
It's different this time, John. I mean, I was thinking about when you're talking about how there could be hiking into, a recession in the UK. Well, what's causing the recession is the inflation in the UK. And, the banks are really in a tough spot here where you've got a very high and I think stubborn inflation problem driven by, maybe a temporary commodity price hikes, et cetera. That's part of the problem. But underneath it all is shortages in housing, shortages in labor globally. And the pressure there on the core inflation numbers, we think, is going to be around for a while. So this idea that, we're going to get back to the kind of deflationary period before COVID that we experienced for 20, 30 years and was, a big driver of markets because of low bond yields. We just think that's probably behind us, and the markets need to adjust to a, longer term, something north of 3% inflation environment, a 10-year yield in the 3 to 4% range. And valuations after this last rally are just, especially on the growth side of the equation, which is where we cut again yesterday. Frankly, these stocks are just overpriced. And,
Steve, you've got 10% cash, which is absolutely extraordinary. I never thought I'd say that about Federated, that you're loaded up that much. That's a huge amount of cash, folks, to have in a long-only buy-side fund. How will corporations adapt to this higher inflation regime? How do you presume that your top 40 holdings will adapt and adjust out the next 3 to 5 years?
Well, Tom, one thing that we're overweight is dividend-paying stocks. And, those companies have pretty stable businesses. They've got pricing power. They can gradually increase pricing on their portfolio. They should have nominal sales that will go up with nominal GDP. And the stocks are not crazily priced, and they're throwing off dividends of 3 to 4%. So, getting a return in cash of 3 to 4%, we think is not bad with a little bit of appreciation. We've been telling our clients, the days of 15, 20% per year are behind us now. We got to be thinking about mid-single digit returns on stocks in the next 3 years. I would point out that cash isn't as horrible as it used to be, Tom, when you were, doing your 3X leveraged money market fund. I mean,
Federated stole that idea. John, Federated stole that idea from me, just so you know.
I'm not sure how much money they owe you for that.
A couple of percent right now, and we think they'll be paying 3 soon. So, that's not a bad return relative to bonds, where we think you probably still have price risk on the bond side. So we're overweight cash, we're underweight bonds, we're overweight value stocks, and we're underweight growth stocks, where we think the valuation is going to compress. So it does look it is defensive. It's probably not as ridiculously defensive as you'd think. If you look at, you're expecting a 5 to 7% return over the next 3 years, per year.
Steve, just to put this into cold relief, it sounds like you're incredibly bearish when you say we're now underweight equities for the first time in nearly a decade. What is the nature of the downturn, just quickly, in terms of what you're expecting versus just simply a reallocation based on the first time that we're getting real yield in a very long time?
Right. It's the rocky landing idea, Lisa. We don't really think we're in for some sort of crisis recession here, although, there's possibilities of that. But we're looking at a rocky landing. We think we're going to be bouncing around real GDP growth in, plus or minus 1% for the next 6 quarters. We think inflation's going to stay pretty high, come off, the levels we are now, but still pretty high. And the Fed is not going to pivot because the playbook they're following is the 1970s, where the Fed made the mistake of pivoting too soon, and that led to a resurgence of inflation that caused Volcker to have to tank the economy into a double-dip recession, as everybody knows, in the late 70s, early 80s. So I think that's the playbook they're playing. I am totally not expecting anything dovish out of Jackson Hole on Friday, and I think the rally's just gotten a little bit ahead of itself, frankly.
Hey, Steve, awesome to catch up. Steve Orth there at Federated Hermes with a very, very different perspective relative to what we've heard from him, Tom, for the last decade or so.
Yeah, really, we want to emphasize to people, we talk to these guests time and time again, and that is a new Stephen Orth.
Brilliant lineup this morning. We'll catch up with Jan Hatzius at Goldman Sachs at 7 a.m. Eastern time, so we'll do that in about 50 minutes' time as we continue to count you down to Jackson Hole, Wyoming, and the annual Fed get-together, where we'll hear from Chairman Powell this Friday. Futures up 0.2%. That's a small bounce relative to the move downwards we've seen over the previous 2 days. It's a cloudy New York City this morning. Bramo, what did you do? Good morning to you.
Thank you.
This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. There are signs that fears of a recession in Europe may be coming to pass. Economic activity in the Eurozone fell for a second month. August's drop was driven by manufacturing. Still, the post-lockdown rebound in services like tourism almost ground to a halt. Consumers have been hit by big jumps in energy and food costs. And those gasoline prices in the U.S. have now fallen for 70 days in a row. That is the most in more than 7.5 years, according to the Auto Club AAA. Pump prices are averaging $3.89 a gallon after reaching a record high of around $5 in mid-June. And the U.S. warns that Russia is about to launch a new round of attacks against Ukrainian government facilities. Ukraine's preparing to celebrate its Independence Day on Wednesday. President Volodymyr Zelensky says that Russia, quote, may try to do something particularly nasty. The U.S. government reportedly has recovered more than 300 classified documents from Donald Trump since he left office, according to the New York Times. That includes papers returned in January, a second set given to the Justice Department in June, and the documents seized by the FBI at Mar-a-Lago. The Times says some of the documents came from the CIA and the National Security Agency. Shares of Zoom are lower today. Second quarter results showed that its transition from an essential COVID-era tool to an enterprise business platform will take longer than usual. Zoom reported the lowest sales gain in its history, plus its revenue projection fell short of estimates. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We are working hard to become independent of this gas supply, and we are doing a lot of investments to make it happen, and we are doing it as fast as ever possible. Never such an infrastructure has been built in Germany in that a short time.
Chancellor Scholz has got a lot of problems. I imagine being in Canada is not one of them right now. He wants to get away, TK. Get away fast. Problems at home building up in Germany and Europe. Lisa, it was just let's let it go. All right?
To Canada?
Yes.
He's going to escape to Canada?
Maybe just let it go. It's still early. Let me get through the market check. Then you can say whatever you want.
I'm not saying anything.
You can say whatever you want. I'm not going to police anything.
Here. No.
Say whatever you like.
I love those markets. Look
Futures up a little more than 1/10 on the S&P. On the Nasdaq 100 up by 0.14%. Yields unchanged just north of 3%, 3.0183%. Lisa, got things to say? You good?
I'm so good. This is great.
You're done.
Yeah,
TK, how are you?
It's a domestic. it's a domestic.
When are we getting in the same room? What are we still doing out here?
I don't know. Are we on the same? I don't think we're on the same plane. I was going to take the Gulfstream, and they wouldn't let me because of the carbon footprint.
We're on different planes.
We're on. I think all of us have to fly on different planes.
No, actually, what's actually happening on Wednesday is I'm on the first flight with you, and I'm on the second flight with Lisa.
Just
to make sure you all gradually get there and you don't get too jealous about one person being with the other for too long. I've split up the trip.
I'm going to ride an elk there.
I'm threatening to read Elizabeth Economy on China on the plane.
On the way to Jackson Hole?
Yeah.
Okay.
Sort of what
I'm pleased to know that you'll be dialed in on Fed
Thank
policy.
What we can do is we can waltz from the west to the east on 96th Street in Central Park. We can do that past the tennis courts, past the lake, wave to vet bill and kennel fee as you walk by. There's been a lot of walking done in the Democratic Party, and today there is an election in New York. Granted, it's about New York. It's not about the rest of the nation. But nevertheless, Joe Matthew knows the distance across Central Park says much about the Democratic Party. Joe, it's Nadler and Maloney. They've been doing this forever. Everybody's focused on this race. What does it symbolize to Mr. Schumer and the future of the Democratic Party?
Well, for Schumer, it looks like a win. He endorsed Jerry Nadler, which has gone a long way to help his standing here when you look at the numbers. But this is why politics can be a very dirty business.
Yeah.
These two were allies. They were elected together in 1992. They were part of the senior leadership in the Democratic-led House. This would be like, Tom, like if you were competing against John Ferro on some other network, looking back on the days in which you co-hosted Surveillance, and things get ugly when you start to compete. I mean, you know,
Joe,
line
you're
that
describing Friday. Okay. Joe, what is
that? May be true.
Okay, what's the difference between Nadler and Maloney?
Well, a man and a woman, if you ask her.
Really?
If you saw, look, you've seen the ad. You can't send a man to do a woman's job, and she has reminded people of her work as a pioneer, the first woman to chair the powerful oversight committee, and has really kind of gotten her arms around reproductive rights as an issue for New Yorkers here. Jerry Nadler, though, will say, hey, listen, fine, if you get rid of me here, you're not going to have a Jewish member of the delegation in an incredibly important part of the country here. New York Times endorsed him. Chuck Schumer endorsed him. I think we see where this is going to go here. But to see two powerful incumbents like this who have been allies for so long, for 30 years, is quite remarkable.
Why? Why is this happening, Joe?
It's all about redistricting. Look, you know, when the maps change, sometimes powerful neighbors can find themselves in the same district, vying for in some cases similar patches of voters here. This is going to look a little bit different for both candidates, though, once the new district is in place.
Joe, I ask this because I know down in Florida, Ron DeSantis is running uncontested in the Republican primary there, and the contest is really among Democrats. How much is this a theme, with Democrats having contested primaries and Republican incumbents having much more power heading into this November 8th election?
It's been a bit of a theme. We've talked about this, of course, repeatedly over the course of the primary campaign. Democrats have tried to prevent that from happening in a lot of cases, and in some cases it's inevitable. When you redraw a map, there's not a lot that can be done about it.
So, Joe, one of the big themes has been that Democrats aren't losing as much as people thought. You have even Mitch McConnell coming out and saying that there's a likelihood that the Democrats will keep the Senate, even if they have to give up the House to Republicans. How based in truth is this, based on the polls, based on the activity in some of these primaries?
It's hard to tell when you start talking about polls, because national polls in the midterms are very difficult to tie to reality. When you start particularly looking at generic ballot polls, they play well for Democrats right now, but of course that doesn't jive with President Biden's approval ratings, and it doesn't really add up to what we're talking about here every day with regards to inflation and so many of the other issues that have been dogging Democrats here. So it's hard to say, but when you hear Mitch McConnell speaking to it to the extent that he did and referring to candidate quality, he's talking about the Herschel Walkers, the J.D. Vances, the Dr. Oz's, who he doesn't feel a great amount of confidence in. They're Donald Trump endorsed products and not the candidates that Mitch McConnell would have chosen. That doesn't mean, though, Tom, that we don't wake up surprised on that next Wednesday morning when they've all been elected. It's too difficult to tell.
Joe, on Wall Street, there's a kickoff to after Labor Day. September is the beginning anew. Should we be surprised to see Biden administration changes in September?
September might be a little early. That might really follow the midterms. You know, November isn't too much later, obviously. But yeah, it's just to keep from muddying the waters here and getting in the way of the narrative. I think what the president is planning, though, is a national tour. Whether they put him on a train or send him on Air Force One, you're going to be seeing him in a lot of cases, Amtrak Joe, trying to make the case for infrastructure and things that no one's talking about here. All the while, foreign policy surrounding this president as he spends a little more time in Delaware here. It's a very quiet period in Washington, but they are busy talking about these plans that they're making for fall.
Do these candidates, Joe, want Amtrak Joe to stay in Delaware?
That's the question, and it depends who you ask. For some, look, being on stage with the commander-in-chief is a big deal, but you are going to see kind of a case-by-case situation. It depends on how well Biden played in that given district that you're talking about in 20 and exactly what the economic straits are in that area. If we're talking about inflation as opposed to, infrastructure, I won't say build back better, some of the other legislative accomplishments that the president has made, yes, he'll be welcome. John Fetterman in Pennsylvania, for instance, says he welcomes the president on stage anytime. So you're going to see different versions of that across the country, and that's not a Joe Biden phenomenon. Realizing his approval ratings are deep in trouble here. That happens in midterms, where commanders-in-chief, based on the historical trends, really don't always help people who are running for Congress.
Joe Matthew, great to catch up. Don't miss Sound On Bloomberg Radio, weekdays, 5 p.m. Eastern Time. TK, what are we looking at now? Democrats keep the Senate, they lose the House?
Yeah, that's sort of the new zeitgeist. It's very fluid right now, and it helps to have someone like Joe Matthew who's just steeped in this stuff. I could never do what he does, John. I don't have the brain for it. All the back and forth.
We'll catch up with Mark Howard of BNP Paribas on this market in just a moment. Futures unchanged on the S&P. From New York, this is Bloomberg. This equity market bounce this morning is struggling to hold. We fade. Futures now unchanged on the S&P 500. On the Nasdaq, very slightly negative. On the S&P over the last 2 days, the biggest two-day drop since the middle of June, down about 3.4% on the S&P 500. That's the equity picture. Here's the bond market story. The first day of August at the close, your 2-year was at 287. Look at it now, 333. Yields up again by a couple of basis points. The highs of the year intraday on a 2-year, 345 TK. So not a million miles away. And the direction of travel over the last few weeks, you've seen it. Yields higher at the front end.
John, this is really, really important. Any good moving average, and you don't want to hang on moving averages, but the moving average that I use of the 2-year yield is demonstrably higher yield than it was in June. It's the sustained nature of the 2-year move now that's important.
So what we've seen now, Tom, is the 2-year yield start to break out. Back to those June highs again. Not quite there yet, but it's happening.
But the moving average is above.
And as that happens, Tom, the dollar's strength starts to boil. And we've seen that in the last couple of days, haven't we? Let's take a picture of euro, dollar and sterling. That's for Bramo, just sort of emphatic language about bad things happening. Euro, dollar, a break of parity in the last 24 hours. Cable, a break of 118 at 117.54. For the UK and the Eurozone, Lisa, the data, terrible. Manufacturing, both in the UK and Europe, in the 40s. And for people familiar with the data, you all know the difference between 50 plus and below is expansion and contraction, and that is solidly in contraction.
And we were kind of expecting that kind of weakness from Europe, but the confirmation of it in the biggest economies, in Germany, in France, has really gotten a lot of people concerned. And I will just say I should change my Twitter profile to speaking emphatically about bad things that could happen to us.
It's a toxic brew, Bramo.
Toxic brew.
All right.
More euro weakness, TK. On the screen this morning.
Yeah, very importantly, sterling down to 117.18, I believe. We didn't see a 116, virtually unthinkable a number of weeks ago. Mark Howard is seeing the unthinkable, holding court at Barclays, and now senior multi-asset specialist at BNP Paribas with a very important research note always on fixed income right now. Mark, you go to where I am. You and I are in the same camp. It's not about single picking the moment as the media does. You look for a message of a sustained strategy by the Fed. What will be sustained about Chairman Powell's speech on Friday?
I think what's going to be sustained, Tom, good morning. Thank you for having me. I think what's going to be sustained is the focus on trying to squeeze out inflation to the extent the Fed can. You know, they had to scramble to get caught up, which caused the markets to, to overcorrect on the downside through mid-June. And then we had a little bit of good news, a little bit of dovishness, and now I think he's going to set the record straight and say, don't expect a dovish pivot anytime soon. And that's why we've seen the front end, your warp measure, adjust over the last several days. There's not going to be easing anytime soon in our view.
Non-pro question. You are a dyed-in-the-wool optimist. Do you share the gloom that's floating around right now?
Well, I don't know that it's gloom, Tom. Your earlier guest, Mr. Auth, I think had the right tone, which is that inflation is a real challenge, not just in the U.S., where we've seen it, settle a little bit, but you guys mentioned yesterday what's happening in the U.K. And in many of the emerging markets. There's a real challenge, and central banks globally are going to be squeezing against that, and that's going to weigh on growth. And ultimately, with the lagged effect, that's going to kick into corporate profitability. And I think it's prudent to not expect the market to continue to rebound. I think we're going to settle in here. Our target for the S&P, for example, is 4,400 by the end of the year. So we think it's appropriate for the market to have leveled off recently.
Mark, you and your colleague Sam Linton-Brown had the courage to buy some of that weakness in the middle of June, and you and I have talked offline about that. You've always got to think about the story. Okay, might not sound good, then think about the price of the story. Can you talk to me about the price of the story in Europe now? We're all familiar with the story. It's not great, is it? Talk to me about the price of the story. How well priced are we for that pretty terrible picture we're expecting at the back end of this year?
Yeah, I thank you for the kind words. You're right. Sam and team definitely had a courageous call, and rightfully, I think, have recently started to moderate that call to be a little more balanced in the outlook. So, the European outlook, as you've rightly highlighted, is quite challenging, not just on the continent, but also in the UK. And with what's happening recently, just the last several days around power and energy prices, there's genuine reason to be concerned of real stagflationary pressures as the year plays out. We do believe the central bank in both ECB and the UK will hike in September, and that's a very challenging near-term mix for risk assets. But ultimately, we don't see a major correction in European asset prices, but we do see a choppy road ahead.
Mark, you talk about hiking into weakness, and this has been a theme throughout 2022. What's the trigger point for central bankers to stop hiking? And this has been what people have been really debating as to the pivot that some people said never happened, and how Jay Powell might reiterate a hawkish message on Friday.
Well, I think there are several different things. It's not a linear line that you get to this point and then they stop hiking. Clearly the global economy is going through a downshift. You guys haven't talked much this morning about China, but you did yesterday. And, that's another variable that I think is important. So growth, I think globally is going to moderate a good deal next year. And I think that's going to create a window of opportunity after the Fed has hiked further in September, November, and December, probably by 25 basis points, those last two this year, to take a pause and let the contractionary impulse of that monetary policy and QT play through to the real economy. And that's when they're going to reassess. That's when we're going to see a pause in the hiking cycle. They may have to hike further if inflation doesn't moderate as they expect. Yeah. But I think with the negative impulse of global growth, China and Europe in particular, weighing on U.S. growth and export activity, as well as the strong dollar that you referenced, all of that should create an opportunity for the Fed to take a pause early next year.
Mark, since we haven't mentioned China, it's a perfect opportunity for us to do so. Where has the market not priced in the slowdown that we're seeing actually confirmed even by official data coming out of China?
Where have we seen that priced in? Well,
where have we not seen that priced in to the extent that you think we should?
It's we've certainly seen it in the currency. I think it is fairly priced in. We've seen obviously real stress in credit in China. We've seen equities which had a rally earlier this year have come off. and the currency is moderated. So I think it's reasonably priced in. Chinese markets are very, very tricky, as you know, much more so than the Western ones, just because you don't have clarity. It's not just a fundamentally driven market. You've got incredible monetary and governmental stimuli and contraction that can go on. I think markets are fairly priced in China, reflecting the uncertainty because, as we know, this is a big year as the year plays out with their forum. We don't think they're going to let the economy collapse a whole lot further.
And Mark, you speak with a certain authority here. BNP Paribas has an absolutely unique relationship with China going back to 1860. On my first trip to China, folks, I had the honor really, of meeting with senior BNP officials and government officials in Beijing. It was a unique meeting. Mark Howard, does the United States risk ceding China trade and commerce to Europe? Is there a point here where Europe, and particularly BNP Paribas France, can be opportunistic and get a marginal edge in China?
Well, my good friend and colleague George Sun is the best person to ask about that because he's on the ground and he's watching the flows day to day. But I think that China is a global player, and they have bilateral relationships with all the leading trading partners, including those that have big financial institutions. I'm not sure that it's a regional opportunity or risk that you framed right now. I think rather it's in market by market, product by product. It's in the best interests of all global players to continue to support trade, even though there are tensions and frictions. The One Belt, One Road initiative and the variants of that create opportunity for European institutions and for African and for American, and I think that's going to continue to be the case. But certainly there are going to be fits and starts, and there are going to be periods where one country or one institution finds itself on the back foot temporarily. But the leading global players will remain, I think, committed to China.
Mark, I just want to pick up on something you said. I'm always interested in the language we use to describe China. They won't let it happen. Mark, that implies they have a greater degree of control over the situation, that it's up to them not to allow things to happen. To what extent do you think they actually have control over some of these dynamics taking place in this economy?
Well, it's not just the ability, but the willingness, Jonathan, and that's why I phrased it that way. There are certain circumstances like the housing and the property markets where they have the ability to pump things up. They have the ability to insert capital and stabilize financial institutions or construction companies by orchestrating the workouts of debt. We don't do that in the West. We don't do that in the UK or Europe. So that's one example of where they have clearly in the currency markets as well. And given the importance of export activity for them, they have the ability to maneuver their currency in order to support key sectors of their economy. And they use the regulatory switch rather aggressively too. So they have the ability to support some of their domestic exporters at the expense of other players. So I think they just do it more frequently, which in my opinion means that they're more likely to intervene and support growth and other priorities.
Hey Mark, good to catch up. Send our best to the team, won't you? Mark Howard there, BNP Paribas. Bramo, I think that's an important dynamic to think about in China, because if they do face what some people fear they face, which is some form of liquidity trap, they're not allowing things to happen. Well, it may be out of their control as to whether it happens or not.
Especially because Leland Miller yesterday was saying they really haven't put that much stimulus into the market. You saw a faded response to the stimulus they did start to put in.
We'll build on some of this conversation around China. We'll catch up with Tina Fordham in just a moment of Fordham Global Foresight. Futures up 0.2% on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The US says that a nuclear deal with Iran is closer than before, but gaps still remain. A State Department spokesman says Iran has appeared to drop some of its, quote, non-starter demands. The Biden administration continues to review the EU's latest proposal to revive the agreement curbing Iran's nuclear program. Hedge funds are unleashing record bets that the Federal Reserve will stick to its hawkish script at Jackson Hole. The group has collectively placed a big short across futures for a key overnight rate that moves in line with the Fed's benchmark. That position will benefit if Fed Chair Jerome Powell effectively rules out a dovish pivot when he speaks at this week's symposium. And the price of U.S. natural gas rose above $10 per million BTUs for the first time since 2008. That extends a rally driven by concerns that global stockpiles aren't enough to meet winter demand. In the U.S., inventories are well below normal after summer heat boosted electricity demand. Meanwhile, production has grown only modestly. And life expectancy in New York plummeted by 3 years in 2020. The CDC says that was the biggest decline among all states in the first year of the COVID pandemic. Residents of New York are expected to live to just under 78, the 15th highest life expectancy in the country. Overall, U.S. life expectancy plunged by 1.8 years in 2020. That is the biggest drop since World War II. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're seeing increasing downside risks to the European economy. Naturally, what's going on with the natural gas situation is a key contributing factor there. And so we're targeting 97 on Eurodollar. We think that there's more weakness to come for the euro and more strength to come for the dollar.
As Matt Hornback and Morgan Stanley looking for that weaker euro. We've had 4 days of it now on Eurodollar. From New York City this morning, good morning. Tom Keene, Lisa Abramowicz and Jonathan Ferro. Futures up just a little bit. Let's call it 0.2% higher on the S&P, 0.25% higher on the NASDAQ 100. I've got to get used to quoting this. 99.27
I'm not
on
used
Euro
to it.
dollar.
Yeah, you look at it, you're like, wait, there's a typo.
Where's the other number? It's gone. We're negative 0.16%. That's more euro weakness out there and some more dollar strength, Tom.
It is. Right now, let's get to this because I think it's so important. It's a bit away from what we're doing in the markets. John and I will do that with foreign exchange here in a moment. Sterling 117.62. But on the fracture of international relations in Europe and the unspoken, Tina Fordham joins us right now, founder and geopolitical strategist at Fordham Global Foresight. I look, Tina, at where we are and the bombing in Moscow and all that, and there seems to be an unraveling. In our world, it is the parabola of energy prices. In your world, it's something like Ms. Meloni in Italy, with not fascist, but certainly very austere tendencies like what we see in Hungary. How unsettled is Europe given the energy price overlay?
Well, Tom, you've highlighted some of the themes that are interwoven really in the global political risk outlook, where those high energy prices you mentioned, of course, are being driven by the continuation of the Russian invasion of Ukraine, which shows no sign of abating, plus the long-standing Kremlin policy of intervening in European politics. It's not illegal, first of all, for European political parties to actually take funding from other countries. And furthermore, this is long documented. Viktor Orban's connection to the Kremlin, Matteo Salvini, who's on the record today from the Lega Nord party in Italy, saying that perhaps sanctions against Russia aren't working. So while policymakers and markets are, rightly focused on the kind of harrowing inflation outlook, which is taking up the reaction function and the attention, these cracks are really concerning. And the September elections in Italy are going to put a prime minister in office who is uncomfortably close to fascist tendencies and with connections to Russia.
I mean, the shock of the pricing is so tangible. There's got to be, my reading of history here, and it may be 1938 on to whatever, you can pick your point of gloom, but the fact is this pricing leads to international relation and political adjustment. What would you suggest that adjustment will be?
Well, at the first level, it's going to lead to enormous household distress. And I see that through the lens of what's happening here in the UK with the leadership contest for the Tory party and the talk about the energy price cap. You know, we're talking about households seeing a quintupling in their energy bills, a normal household paying, you know, over £1,000 a month for electricity. It's a shock that is not going to be able to be absorbed. So first of all, I think there's going to be mass non-payment. And if you look at the dynamics of the Tory leadership contest, it's all about getting those 160,000 Conservative Party voters. It's a different platform. So this government is going to be reactive. By contrast, Macron in France has been more proactive, saying it's basically the patriotic duty to kind of deal with it. And we have to stay strong in the face of Russia. I think that Europe's resolve when it comes to supporting Ukraine will continue, but there's going to be a lot of pain. This is going to hurt. And you asked what the kind of policy response is going to be. People look at the pandemic and they're going to expect government support. How we get there is very hard to say, but the public won't be able to absorb price increases of these proportions.
Tina, you went where I wanted to go, which is you said that the resolve will remain strong to support Ukraine, to battle Russia, and that the European people will continue with that message. When does that fray, especially as power costs rise and there is an increasing chorus of people saying perhaps some of the sanctions and some of the measures taken against Russia were as penalizing to the Western nations as anyone else?
Well, I mean, it's always a question, right, of what's the alternative? And there's no going back to Russia as an energy supplier. Those days are over. And the substitution of supply is already happening. We are, however, looking at a very difficult winter here, one that people aren't used to. You know, in the old days, at least you had a fireplace and you could chop firewood. Now it's central heating, which means people are going to have to turn it off. So it's going to be incredibly difficult. But what you do see in Europe is an increasing sense that Ukraine has to win this conflict. And there isn't going to be a turning back from that. But I guess what I'm trying to say is that maintaining that position of support and the sacrifice that it's going to entail for households means you have to accelerate the green transition. You've got to keep those nuclear power plants going, which is a huge turnaround for German policy. And that's happening rather quickly. Not quickly enough to alleviate pain this winter, but I think quickly enough. And again, we can't go back to Russia as a dependence upon Russia as an energy supplier. They are not a dependable source.
These are huge, huge changes we need to try and adapt to. Tina Fordham of Fordham Global Foresight. And Tom, I really want to pick up on that. I think we're all struggling collectively to process some of these numbers and some of these moves. And we haven't even started to think about the so-called second round effects of all of this. Yesterday, we talked about Citi's forecast for inflation in the UK maybe peaking at 18% in January. It just feels like a number we're throwing out there, Tom, without even really thinking through.
I totally agree.
What on earth that means. And Tom, I'd go a step further. I think we have a relationship with the barrel of oil in a way that we don't have a relationship with the gas price. I could tell you gas prices are up by 40% or so in Europe on the month. But Tom, I don't think we really understand what that actually means for the European consumer this winter.
Yeah, and this is really important in that it's part of what we're doing at Bloomberg, and, you know, the invention of surveillance and all that, John, is by definition we're removed from all this. But to your point of second order effects, at the second order, the second round, if you will, as time moves on, things change. And where Tina comes in and others in international relations is trying to look to the past and the ghosts of the past and say, what's different this time? And that brings an urgency to the fourth quarter of this year that we haven't seen in ages. These are parabolic moves, John.
Huge moves, Lisa, and really complex issues.
And they're trickling out to just beyond the Eurozone. You're seeing natural gas in the U.S. also surge to the highest level since 2008. So becoming global, raising that issue. How divergent can these economies really be?
We'll catch up with an economist next, Jan Hatzius of Goldman Sachs, coming up in about 5 minutes' time. From New York, this is Bloomberg.
The Fed and Powell in particular needs to get across the message that the job is not yet done.
It's not just about what the ECB does and what the Fed does. You have to take into account the market's inflation premium.
We're really playing a game where the market desperately wants the Fed to react.
We are still very much in the early days of recovering off of an extreme low.
Right now, central banks everywhere will take anything they can get.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Gramo's got things to say about Goldman HQ. She's going to share them a little bit. Like, seriously, maybe.
How are you
from New York City this morning.
Good
morning, good morning. For our audience worldwide on TV and radio, alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures TK positive 0.1%. It is all about the data in Europe, and it's the US next up.
It's about the data, the shock of looking at the Bloomberg terminal. We're going to review that with you throughout the hour and, frankly, throughout our trip to Jackson Hole and what we'll hear from Chairman Powell on Friday. John, I want to go to the Great Divide of America. This is something Jan Hatzius did years and years ago. Macy's just out, John, and buried in it is the comp sales at working-class Macy's, negative 2.9%, and at fancy Bloomingdale's, where Mrs. Ferro shops, up 8.8%. That describes the divide of this nation.
The words you don't want to see from retail right now: markdowns, promotions, Lisa, inventory, aged inventory. These are big, big problems that we were hopeful that Target had worked their way through. Macy's, it just seems they're just starting.
The problem is that they actually beat expectations when it comes to sales. However, when it comes to their forecasts, they ratcheted them down because of the expectation of consumers slowing down their purchases. How do you get ahead of such a quickly moving tide of consumer sentiment and the post-pandemic reality, John?
Well, they've had to cut their guidance this morning. Futures right now positive about 0.1% on the S&P. Macy's just about positive as well. On the NASDAQ 100 up by 0.15%. If you take a look at the bond market, yields unchanged at just north of 3%. That's the breakthrough 3 we've seen in the last 24 hours. But the move in foreign exchange, Bramo, you've got to get used to it, haven't you? 99.24 on euro dollar. It's a clean break of parity in the last couple of days. We're down 0.2%.
I keep thinking about Jordan Rochester as 95, the next target here, as people expect that downturn in Europe to deepen with higher gas prices. What we're watching today, 9:45 a.m., we do get a series of PMIs out of the U.S. for manufacturing as well as for services. Although at 10 a.m., this is what I'm watching in terms of data. U.S. July new home sales. How much do you see activity in the home market really deteriorate on the heels of higher mortgage rates? At 1 p.m., the U.S. is selling $44 billion of two-year notes. This is fascinating to me, especially as people position for a hawkish speech from Fed Chair Jay Powell. How much interest is there going to be at two-year yields? Yes, you're actually getting something for cash. We've been hearing about that from Steve Auth and others at 3.3%. However, what is the risk of the Fed going much further and staying there longer than people are currently expecting? And we were just talking about Macy's. The earnings season is kind of dripping to its end here. We've got Macy's that just came out. Those shares up now 2.2%. They did beat on the sales. However, they downgraded their overall forecast. We also hear from Dick's Sporting Goods and Nordstrom after the bell. How much does Macy's really become the theme in terms of the mood going forward? What does it say about the consumer, John, at a time where they've hung in there for now, but there's the expectation that it is a temporary resilience that will fade?
That stock this morning hanging in there for now, up by a little more than 2%. Lisa, thank you. Joining us now, we get really lucky. Jan Hatzius, chief economist at Goldman Sachs. Jan, let's talk about it. China, GDP forecast over at Goldman now 3% for the year. Europe, base case for pretty much everybody. They enter recession. Jan, where on earth does that leave the US economy?
I think the U.S. doesn't have quite the same degree of headwinds as both China and Europe. In China, obviously, you have the zero COVID policy and the property market downturn, which is a multi-year development. In Europe, you've got the gas issue. There's nothing quite to the same degree that we have in the U.S., but it's going to be a slow growth environment, below trend. The Fed wants below trend. That's why financial conditions are where they are, because the Fed's tightening pretty aggressively. And you've got the fiscal drag. So plenty of headwinds for sure, but I don't think it's quite as bad as in China or the euro area.
How do you expect Chairman Powell to navigate that, Jan, this Friday?
I think he'll be balancing between two things. One, I think he will lay out a case, as he did at the last press conference, as they did in the minutes, for slowing the pace of increases. We had 275 basis point moves. Our expectation would be, barring significant data surprises, that the September move is 50. I think I don't think he'll be specific about the number, but I do think he'll be saying, there is a risk of over-tightening, and therefore it makes sense to go a little bit more slowly than these really outsized increases. But at the same time, he'll make clear that the job is not yet done. Inflation is way too high. They're very committed to bringing inflation back down to 2% or thereabouts. So I think it will be a balancing act.
Yeah, and there's a mix here of themes, and one of them is what we just saw from Macy's, where Bloomingdale's and the haves do well, and Macy's and the have-nots really are struggling. Or it could be John Taylor of Stanford visiting with Bloomberg in the last 24 hours, saying sustain, sustain, sustain a higher yield environment. Are we getting our x-axis wrong right now? Do we need to look out 2 years, 3 years, or 5 years of elevated inflation?
I think a year from now, or 2 years from now, inflation will be much lower because there are some drivers. I mean, commodity prices are clear. The goods sector in general, I do think that's going to come off a lot. The risk is more on the services side, where we've seen less of an indication that things are slowing, especially rents are still growing very quickly. So I think that's still going to be well above normal, into 2023 and maybe even beyond. So I do think that there are going to be improvements, but not everywhere.
Should we have a more nominal GDP, nominal inflation analysis witness the haves and the have-nots? The have-nots are getting crushed minute by minute. Should we switch to a more nominal study?
Well, I think what you're suggesting is that we look at the distribution of incomes and spending, and you clearly see some big differences there. And I think, Macy's versus Nordstrom's is a good example. You can look at real income at the top end, at the bottom end of the income distribution. There's been a much bigger pullback at the bottom end, in part because the fiscal support was so much more important there, and that's come off, and in part because at the bottom end, you see more of an impact from gas prices and inflation generally. At the margin, the drop in gas prices obviously is helping somewhat more at the bottom end, but that's only a small part of the previous deterioration.
There is, however, Jan, at least with physical goods, a bit of a disinflationary pressure, whether it comes to inventories or some of the commodity prices that have come off. Is it enough to achieve a soft landing? Have you actually improved some of your forecasts about what the Fed has to do and the outcome in the U.S. economy?
I think it's certainly helpful, and we've continued to be in the softish landing camp, in part because of the expectation that some of the goods pressures would abate. The most important factor, though, is adjustment in the labor market. That's something that they need to pull off, and I think we've seen some encouraging indicators, in particular the 1.1 million decline in job openings that we've seen in the JOLTS data, which is probably still underway. We'll probably see some further significant declines there. That is starting to bring the labor market into better balance. Still early days. We still have a large gap between jobs and workers, but at least we're moving in the right direction there, and I think that's going to be key to sustain it.
Do you think that the market right now is not reflecting what still has to be done, though, from the Federal Reserve in order to achieve that? And this is something that we've heard about throughout the morning. The theme of the day has been that stocks need to wake up to it. That is the bearish tilt. Do you agree with that right now they are not accounting for the pain?
I think the terminal rate pricing doesn't look too low. I mean, it's sort of 3.5 or a little bit more. I think that is sufficient relative to our forecast, maybe even a little bit more than sufficient. Where I would disagree more with market pricing is the pricing for significant rate cuts. I think that, certainly could happen and would happen if you went into a recession. But I think in a slow growth environment where the Fed is trying to squeeze inflation lower, I think they'd be very resistant to rate cuts. So I do think that those cuts are probably somewhat excessive from a market pricing perspective.
It's a raise and hold strategy, in the words of San Francisco Fed President Mary Daly. Jan, have you got any idea of how you think they will hold rates at that kind of level? For how long? Is it too early, too premature to have that conversation?
Oh, I think it could be a couple of years. I mean,
really?
If you get to the mid threes or maybe even a little bit higher, and then you stay there, because I think while inflation will look a lot better a year from now, I think it'll still be significantly above the target, and ultimately they do want to get back down to pretty close to 2%.
Jan, that is totally out of consensus. How much pushback do you get from clients when you bring that up?
I think it's away from market pricing. I don't know if it's as out of consensus in terms of what forecasters are saying. I think there are quite a lot of forecasters and Fed officials. I mean, you just mentioned President Daly. Fed officials who are saying that this is a reasonable baseline.
John, squeeze one more question in here, because the bottom line here is simple. This is the theme of Jackson Hole.
But I think this is the difficulty.
This is the theme.
Jan, 3.5%, if you're going to hold rates at that kind of level, and it could be, I stress you said could be, a couple of years, where does a soft landing fit into that kind of profile, that kind of rates profile?
Well, I think that is a soft landing kind of assumption. If it wasn't a soft landing, if you went into a recession, then I think you would get cuts. But if growth stays at 1%, 1.5%, labor market continues to adjust, inflation gradually comes down, and the Fed in that environment keeps the funds rate relatively high, I think that is a soft landing.
Absolutely fascinating. Yeah. I think we'll continue this conversation. Jan Hatzius at Goldman. Jan, great to catch up, sir, as always, with Tom Keene and Lisa Abramowicz. And I can see Lisa at the corner of my eye with things to say.
So much.
Things to say, and not on Goldman's HQ, where it's located, but more just on, can you imagine, Lisa? 3.5% for a couple of years.
I'm looking at investment-grade bonds. The all-in yield was below 2% not that long ago.
You'd have to imagine, to Jan's point, that growth has to hold up for that to happen.
Yeah.
Do markets need to readjust in a different way? Is that what you're suggesting?
Well, we can have a discussion. This is a fascinating one.
The future's unchanged on the S&P from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Gasoline prices in the US have now fallen for 70 days straight. That's the most in more than 7.5 years. According to the Auto Club AAA, pump prices are averaging $3.89 a gallon. That is after reaching a record high of around $5 in mid-June. There are signs that fears of a recession in Europe may be coming to pass. Economic activity in the Eurozone fell for a second month. August's drop was driven by manufacturing. Still, the post-lockdown rebound in services like tourism almost ground to a halt. Consumers have been hit by big jumps in both energy and food costs. The U.S. warns that Russia is about to launch a new round of attacks against Ukrainian government facilities. Ukraine's preparing to celebrate its Independence Day on Wednesday. President Volodymyr Zelensky says that Russia, quote, may try to do something particularly nasty. Credit Suisse is now focusing more on wealth management while it's making cuts to its troubled investment bank. The Swiss bank is reassigning advisors to its private banking international unit, which goes after high net worth clients. That is according to an internal memo seen by Bloomberg. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Things are a real mess. There's no growth momentum anywhere in Europe. The only place where I can see any growth momentum coming through before the end of the year is probably in the US, and even there it's going to be patchy, but it's nowhere near as bad as it is in Europe, and I think that the US is going to avoid recession quite comfortably.
I needed that calming, soothing music to promo Jackson Hole before Ian Shepherdson of Pantheon turns around and just says things are a real mess. Tom Keene Lisa Abramowicz and Jonathan Ferro. Futures basically unchanged on the S&P 500. Two really tough days for the equity market bulls over the last 2 days on the S&P 500. We've been lower by around about 3.4%. Nasdaq futures up around about 0.1%. In the FX market, euro dollar 99.27. We're down another 1/10%. It's 4 days of euro weakness. And Tom, more weak data out of Europe this morning.
We need to pause on this, John. The bid it gets stressed here about every 20 minutes with DXY out over 109. Greg Anderson at BMO Capital using BBDXY as well. John, I don't even know what to pick here other than sterling had a difficult 3 a.m. and now euro 0.9925 is challenged.
We need to pick up on the conversation we just had with Jan Hatzius of Goldman Sachs, who essentially told us that the hurdle for interest rate cuts next year is much higher than most people think. He also posed the idea, Tom, that maybe you get to about 3.5% and you stay there for perhaps 2 years. That's something that we've not discussed, Tom, in a material way at all.
Well, I've been talking about the x-axis. It's not my job to opine on this. We'll leave that to Dr. Hatzius and other worthies. But, John, I just think it's one outcome that has to be considered at the absolute minimum. And as you and I said earlier, this has got to be, it's just got to be, to me, the core theme here at Jackson Hole leading up to the chairman's speech on Friday. Again, John, we're there Thursday. It's you, me, Grizzly Bears, Lisa, 3 Elks.
Grizzly Bears, thought you were calling Bramo the bear, the market bear alongside us.
I'm actually going to have a bear suit on.
Actually, that would be great. We could get a photo of her next to the 8-foot grizzly bear in the lodge there.
Okay, we'll make that happen.
Which one's
But that's
more
the big
fearsome?
divide we need to discuss on Friday, Lisa.
Yes.
The big divide between a market saying rate cuts, let's go in 23, and some people like Jan Hatzius and the Federal Reserve, for that matter, saying, hold up, hold up.
Well,
we might be holding for a while.
It's the good and the bad of a resilient economy. The good is that it's resilient and that you avoid a recession. The bad, at least for some investors, is that the Fed could keep those rates at that level for longer without torpedoing the momentum. And that's something people haven't really discussed.
We'll have to see on this. Right now, futures a little bit elevated, not quite as elevated as earlier. Right now, quickly, Joe Matthew from Washington. Joe, get out the map. Moscow straight south to Crimea is 1,100 miles. All Putin cares about is Crimea over to Odessa, which is 360 miles. Triangulate this with President Biden in Washington. All of a sudden, what's changed is Crimea is discussed. That was unthinkable, Joe, 2 years ago.
This is very true, and we're seeing this virtual meeting now with delegations from 40 nations trying to put pressure on Vladimir Putin over Crimea. I imagine that he thought this was said and done here, but there's a lot of concern about tomorrow. We're going to be talking about Independence Day in Ukraine and what that might mean for Bridget Brink. Remember, the U.S. ambassador to Ukraine has only been there for a couple of months now. Our diplomatic presence in the capital could be very much at risk if Vladimir Putin, to the point of President Zelensky, who you see right now, could try something cruel, could try something unusual in attacking the capital city on what, of course, is a day of celebration for Ukrainians. So this is a very touchy situation right now as we look across the rest of this week, remembering, of course, that that's the 6-month mark as well tomorrow. This war is 6 months old. We were told that Kyiv would fall in 3 to 5 days when it began. And we're reading stories here on the terminal of the Russian military, again, that is bogged down, and a Ukrainian military that is inspired by the effort to protect its homeland in a remarkable way. Is this going to be something we're talking about 6 months later? That could bring a very different wrinkle to the Crimea story.
And we all hope that it gets resolved sooner in a way that avoids some of the carnage. Joe, we've been talking about the resilience with Tina Fordham, the persistent feeling in Europe that this is an important cause, even as gas prices rise dramatically, even as the pain is borne at home. Is the same true in the United States, as a lot of the surrogates for Joe Biden, whether they like it or not, go out and take to campaigning?
Well, it is for now. The question is, how long can this last? When does the war fatigue set in? When are the louder questions about spending billions of dollars to support the effort in Ukraine? It's actually quite remarkable that there has not been a larger cry, more isolationist view, particularly from members of Congress. But the Biden administration has held true to its promises so far for President Zelensky and the people of Ukraine. Where are we going to be, though, post-midterms? Where are we going to be as we go into the winter heating season? Those are really important questions. The reaction here in the United States could be very different from what we see in Europe.
John Matthew, thank you. Looking forward to the show a little bit later. Sound on Bloomberg Radio weekdays at 5 p.m. Eastern Time. That stat on gas prices, Lisa, is just amazing, isn't it? Was it 70 days?
Yeah. Just amazing.
And still going.
It's still going. And you have seen that completely fall off, even as you see natural gas. We're talking about gasoline, which has come down for 70 straight days versus natural gas surging around the world.
So why can't you just call it petrol? Then we wouldn't get confused. Wouldn't that help out?
That's un-American, John. I'm sorry.
That's very un-American.
What do you want me to call it? Aluminum?
Okay, all right.
It's also
have I
intelligent.
upset both of you?
Like, what is this? So why don't you just call it petrol? We call it gas.
I had a conversation with my producer this morning.
A gas station.
I was talking to Jamie at his desk, and I said, well, yeah, you can't say that because people get confused.
Where's my intern? Can we get some therapy for those two?
Versus natural gas.
They both feel vulnerable.
I mean, is it, in all seriousness, John, in the UK, do you call it a petrol station?
Yeah, it's a petrol station.
Really? But that's so long.
So it's where you get petrol from.
No, it's gas.
It's gas. Okay.
John, can I parse what Hatzius said?
Of course you can.
The sustain here is not a static sustain at, say, 8% inflation. It's if we come down, and it's totally unacceptable for Lawrence Summers and for anybody at the Fed on the other side of the debate, at 3% or 4% or 5%, that's the then what? And that's where you get into the 3-year regime.
You've raised it a few times, Tom, and I totally agree with you. We're talking about a Fed pivot just because we've seen year-over-year inflation peak potentially a little north of 9%. Lisa, it's a big change.
Well, and this is the reason why people say that there is no pivot. I want to go back, though, to what Jan Hatzius is saying. Basically, his implication is that this economy is a lot less interest rate sensitive than people thought, that it can withstand a 3.5% to 4% interest rate for a prolonged period of time without getting torpedoed. This goes against the conventional wisdom of the low rate whole decades, and I find that fascinating.
Does he call it petrol, though? Find that out.
He doesn't.
Find that out.
No.
That's the important piece of this.
John.
Yeah.
Is this what you're going to die on?
John,
really? Petrol?
No, I
we come off set Thursday, and if they're still serving, we're pivoting to the huckleberry pancakes at the Pioneer Grill.
I've got to go on a diet, Tom.
Oh, they're low-cal.
They're low-cal?
They're low-cal.
Low-cal pancakes.
Or at least they told me.
2 days of losses on the S&P 500. The last 2 days down by about 3.4% on the S&P. This morning, just in and around unchanged on the S&P, positive 0.04%. Similar move on the Nasdaq 100. A lot of the pain, the contribution from the front end of the bond market, I think. Let's look at 2 years together. 287 at the start of August. Getting really close to the intraday highs of the year of 345. Right now about 333. Yields up by a couple of basis points to 332.92, and the prospect that maybe the Fed does raise and holds, Tom, at 3.5%, there and thereabouts for a couple of years, according to Jan Hatzius of Goldman Sachs. TK, that's the big divide as we go into Jackson Hole. People looking out to 23 and talking about rate cuts, and a Fed not saying anything about it.
And Anna Wong of Bloomberg Intelligence and Economics adamant that we're going to go much, much higher than maybe Hatzius' center tendency. I'd also suggest John Taylor of Stanford University was forceful with Bloomberg a number of hours ago and just saying, look, we've got to normalize at any cost, and that cost, of course, can be slowdown.
2 questions, Tom, and they're the right ones. 1, how resilient is this economy? And 2, if it's not that resilient, how tolerant will this Fed be of any weakness? And that really means you have to ask yourself the question, Tom, how high is that hurdle for rate cuts from this Fed?
And I would say,
that
John, that hurdle, going back to McChesney, Martin, and Truman, is a political hurdle. I'm sorry. This will get to a point where politics will invade the discussion.
It's not clicked in just yet.
Not
that's
yet.
For sure. When unemployment starts going the other way, Tom, I'm with you. But with the payrolls number we just had a few Fridays ago, that was a very different picture.
Did I do okay there?
You did brilliantly, Tom.
Okay, thank you.
As always.
I'm watching Man U highlights.
Yesterday, I didn't do so well with my football prediction. Let's look at foreign exchange. The best tweet I've seen over the last few days is just a China euro dollar, a break of parity, and the title, Tom, is it's called soccer now. Do you like that? So I guess I'm going to call it soccer.
That leads to the power of the US dollar here.
Dead wrong, Tom. Yeah. Dead wrong. As Man United get it done. But TK, we've got to get used to this. 99.25. We had Matt Hornback and Morgan Stanley yesterday saying 97. Jordan Rochester saying maybe 95 over at Nomura. There's some big calls.
There's some. I always go. I'm genetically going to go to EM analysis on this, and there's certain EM economies that are actually doing pretty good here. It's a developed economy, a developed pair headache right now. But with that said, maybe we do what we always do, John. Watch yen. Yen has not weakened yet.
If you want an EM feel, talk about sterling, 117.68.
Stunning.
Just about unchanged, but numbers that, Tom, I didn't think we'd be talking about for much of this year, I have to say. And 97.95, I say they're big calls, but at 99.22 on euro dollar.
It's a cup of coffee away.
Basically there. Maybe a few sessions away. That's the foreign exchange story, the cross-asset picture. Let's get you some single names. We can do that with Lisa. Hey, Lisa.
Hey, John. If you want an emerging markets feel, take a look at Bed Bath & Beyond's shares. They have been all over the place, losing 60% in 3 trading days. A little bit of a rebound today, up about 4% in revenge of the memes. AMC, I got hammered yesterday because people were saying the huge declines that we had been seeing were not because they were lumped in with the meme stocks, but it was because of Cineworld and their bankruptcy over in the UK, number 2 theater operator, as well as, and this more importantly, preferred shares starting to trade. You're seeing a little bit of a rebound there, not much. There's a big question about live audiences getting back to it in the post-pandemic era. Zoom shares down 11.5% in pre-market trading after downgrading their sales forecast yesterday after the bell. In terms of earnings today, we just got Dick's Sporting Goods, and we did see them beat expectations as well as raise their full-year forecast. You're seeing a pop in those shares in response, 2.3% gain. Macy's up at 2.1%, even though they actually came out and downgraded their forecast, but people were expecting this. To me, that's fascinating. So people are rewarding their beat, rewarding what their delivery was, even as they say, look, it's going to get worse from here. And Nordstrom shares up more than 1%. They report after the bell, Tom.
Lisa, thanks so much. Greatly appreciate it. Long ago and far away, short-term paper in the short-term trust market was either commercial paper analysis or LIBOR analysis. Winnie Caesar knows this, global head of strategy at credit sites. Winnie, I want to start with the gloom that's out there, the stew of Bloomberg surveillance. And the joke we make is it's a toxic brew. The toxic brew out there now. What are we going to learn from the short-term trust market, what we used to call the LIBOR market? What's the toxic brew you see right now in short-term paper, or is it all calm?
Well, I'm not sure about a toxic brew. The front end of the market has clearly had some pretty significant challenges trying to assess exactly where the Fed is heading, seeing a lot of the leveraged loan markets, which it's referenced away from LIBOR towards SOFR. There's a lot of just headwinds going on in the front end of the market, and that's just made it for a really challenging kind of liquidity market more broadly. And then kind of pulling forward some of the big themes that's going on in the front end of the market, you just come to the shape of the curve. And that has been, a real challenge for economists, for corporate credit investors, just for pretty much everyone involved in the fixed income market.
Winnie, when I mentioned toxic brew and LIBOR, did that cause your baby to scream? Did I make a folks pas?
100%.
Okay, Lisa, pick it up. What I said was, I cause a lot of babies to scream. Lisa, pick it up.
Well, Winnie, a lot of people are screaming about the potential for interest rates. Did you like that segue or segue, as someone would say? When you talk about interest rates and how high they could go, and I want to go to this Jan Hatzius theme of perhaps not hiking rates as far as some people are projecting, the Bill Dudley-esque north of 4%, but at 3.5%. For a prolonged period of time. Has this economy become less interest rate sensitive than many people previously had thought?
Well, Lisa, that's a great question. And I think that a lot of it comes down to the shape of the curve in terms of interest rate sensitivity, especially when you look at the corporate credit market. Right now, we have very flat curves, which from a refinancing perspective is actually very supportive. If you are assuming that a company has a maturity that they then roll over into 10 or 30-year debt, the increase in borrowing costs is not nearly as significant if you're assuming that they're going to be just putting in place more 2-year paper and more 2-year paper. So I do think that you can't kind of overestimate the vulnerability of the economy and corporate America to higher yields in general. but there is kind of a lot of nuance in the story.
Okay, so the nuance is where I'm actually curious, because there is this belief, and Matt King has talked about this, that you aren't going to see the same default cycle this time around because the maturities have been pushed out, because companies have so much cash on their balance sheets. Do you agree? Are you going to see pockets of real serious distress as you see interest rates at a higher rate for a longer period of time?
So I think that the default cycle is probably going to look a little bit different. We do have an expectation that heading into next year, defaults creep higher, not from a kind of gloom and doom perspective, not a toxic brew, as Tom would say, but definitely a closer to normalization of a long-term default rate. Now, one of the things that we're observing is there's not a really acute pocket of stress in a specific sector. It was energy for much of the past 8 years. It was telecom at one point. It was autos at another point. Now, instead, what we're seeing is these kind of specific pressure points where there are companies that just got their balance sheets highly leveraged. There was some sort of specific catalyst for that business that has been problematic. And the benefit of corporate America for the past few years is that all of those ultra low borrowing costs really buy a lot of time in a rising rate kind of challenged economic environment.
One more quickly here, if we could. If you do IG, you're legendary at Wells Fargo over the years, IG, distressed, and all the rest of it. Do you make a 10-year full faith and credit call? Do you have a vision of where 10-year yield will be end of the year or out 12 months?
Yeah, so we do make estimates for the 10-year Treasury market, mostly because you have to have that to forecast where the credit market's going to go. We have a 3.4% year-end forecast on both the 5 and 10 years, so still very flat curves, as we did expect that the Fed is going to hike rates into that kind of 3.25%, 3.5% by the end of the year. Curves will stay very flat, and then we do have the Fed kind of staying on hold at that elevated level for an extended period of time to assess that lag effect between policy tightening and actual economic conditions.
Winnie, thank you. Winnie Caesar of Credit Sites, working through some complex issues. If you would like the weekly dose of JP Morgan optimism from Marko Kolanovic, here's the quote. Inflation will resolve on its own as distortions fade and likely drive a Fed pivot. A stronger second half recovery in China should provide support for the global cycle in combination with still very low investor positioning, creates a positive environment. That's the latest from Kolanovic over at JP Morgan, Tom.
John, moments ago, Andrew Hollenhorst, of course, going decidedly the other way, says stop focusing on Powell's speech. It's a quote-unquote a hawkish month. They are adamant that a combination of what Powell will say and the mystery of the data to come should be aggregated together.
Still got payrolls to come before that next meeting.
Yeah.
Got August
inflation
payrolls.
Too.
You've got inflation, I think, on September 13th. Lisa,
so the
road to September in that September meeting is still a long one.
I have a question for you.
Sure.
Are you trolling Marco or the Bears
why would
when
I
you
troll
put that
an
out?
equity strategist?
I mean, honestly,
I'm not.
No. And I mean, but this is a real question, not whether you're trolling him or the others. But he is so controversial.
I try and share a range of views on the sell side.
He is the consistent bull, and his view has not been very rangy in terms of its volatility. It's been very straight.
What's that diplomatic for? Rangy.
It's just been very solid in the bull camp, and he's been unwavering, which it's absolutely valid.
I'm not here to say that anyone's forecast will be wrong. I'm not here to say that anyone's forecast will be right. By definition, it's just a forecast.
He's a lightning rod, though.
I'm just here to work through different processes and different ways of thinking, different frameworks.
From Northwestern, they both sound very vulnerable this morning.
As I pick up that quote from Mr. Kolanovic, though, a stronger second half recovery in China. It's a controversial point.
They have to fly separately,
Inflation will resolve on its own. It's a controversial point.
All of it is.
It's some things to think about.
Yeah.
But if you were running a fund, wouldn't you want the most bearish and the most bullish person to come in and make their pitch? I'd want to hear from everyone.
Absolutely.
Stress test my position. Tell me why I'm wrong.
Fit your narrative to fit my faith.
Or some confirmation bias. I think that's what I'd do. I'd just invite 10 people that agree with me, make me feel really smart.
That's why we're heading to Jackson Hole.
Probably end up losing money. Futures unchanged on the S&P. Basically unchanged across the board here. A bit more euro weakness, 99.23.
We're in a fog.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. The US says that a nuclear deal with Iran is closer than before, but gaps still remain. A State Department spokesman says Iran has appeared to drop some of its, quote, non-starter demands. The Biden administration continues to review the EU's latest proposal to reviving the agreement, curbing Iran's nuclear program. Hedge funds are unleashing record bets that the Federal Reserve will stick to its hawkish script at Jackson Hole. The group has collectively placed a big short across futures for a key overnight rate that moves in line with the Fed's benchmark. That position will benefit if Fed Chair Jerome Powell effectively rules out a dovish pivot when he speaks at this week's symposium. And the price of U.S. natural gas rose above $10 per million BTUs for the first time since 2008. That extends a rally driven by concerns that global stockpiles aren't enough to meet winter demand. In the U.S., inventories are well below normal after summer heat boosted electricity demand. Meanwhile, production has grown only modestly. And Macy's has cut its profit outlook for the full year. The guidance missed the average analyst estimate. Still, the department store operator also posted second quarter earnings that were better than expected. Like its peers, Macy's is contending with shifting consumer preferences and shrinking budgets at a time of decades-high inflation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Where I would disagree more with market pricing is the pricing for significant rate cuts. I think it could be a couple of years. I mean,
really?
If you get to the mid threes or maybe even a little bit higher, and then you stay there, because I think while inflation will look a lot better a year from now, I think it'll still be significantly above the target.
That's the big call from Jan Hatzius of Goldman Sachs, the chief economist. Fantastic to catch up with him early this hour. With Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your market's shaping up as follows. On the S&P, positive 0.1%. On the Nasdaq 100, up by 0.12. Yields basically unchanged, down almost a basis point on a 10-year, 3.0072. The trend over the last couple of weeks, though, higher at the front end. We'll pick up on that a little bit more a little bit later. 99.27 on euro dollar. Here we go. 4 days of weakness for the euro. Again, negative 0.16%. And the PMIs out of Europe this morning, not tremendous, not terrific, pretty ugly. Looking at manufacturing, and not just for the Eurozone, Tom, but for the UK as well.
Really historic moment. Steve Englander to join us in a moment. Right now on DXY, the blended large country index. Kriti Gupta with a chart. Kriti, what do you have?
Yeah, Tom, we're looking at the DXY chart because of that, perhaps a little bit extra weighting towards the euro, and that's really seems to be what's driving the entire market. As you see that dollar strength story, there are ripple effects into the stock market, into the commodity market. But my chart of the day goes back and looks at DXY going back to 2007. We're doing it on a log scale, and we're also looking at the slope of the last time you saw this kind of acceleration in the dollar. It's not just about the stronger dollars, but how quickly it's moving higher. And the last time you saw it was in 2014 and 2008. What's interesting here, Tom, is that those were the two time periods where you saw some significant commodity pressure, which brings me back to the Europe story. It really is all about the natural gas, the oil story that is now pressuring the euro and then in turn driving the dollar higher and higher. So when we think about that dollar tending to weigh on commodities, well, it works the other way around too, Tom.
Kriti, thank you so much. The character of surveillance is simply we want to talk to the best people we can find. And we're honored when they come on short notice. He interrupts this morning with Standard Chartered Bank, their global head of G10 FX research. Stephen Englander joins us on your foreign exchange space. Steve, let me cut to the chase. What is the character, the nature of this historic bout of euro weakness?
Well, I agree that it's largely the natural gas story. I mean, you've seen them in recent days and recent weeks move pretty much together with the euro. There is a broader global story that the market is panicking about what Fed Chair Powell will say at Jackson Hole. And so, euro has two strikes against it, and which is why it went through parity so quickly.
Steve, has the ECB got a role to play here?
Like in a Greek tragedy, there's just not that much that they can do. There's destiny that's approaching. The economy is weak. When we talk about supply chain disruptions. We're not getting our exercise bikes. When they talk about it, they're not able to heat their homes. That's really weighing on sentiment in the euro, and the ECB doesn't have a tool to address it. The UK inflation numbers last week kind of, I think led people in the market to say, why is Europe different and what can ECB do about it? And the market, then when you see the way sterling is trading and euro is trading, the market's really punishing currencies that belong to central banks that have an inflation problem, but are really ambivalent about how they're going to approach it.
Steve, how do you think they should approach it? What's the optimal way to approach the situation the UK is in at the moment, the situation the ECB is in?
It's a very tough situation. I think that when so much is supply shocks, you know, if you're a central bank, you want to try and smooth your response. When you don't know what the duration of the supply shock is going to be, you're really working in the dark. So I think they'll probably hike less than they should. Next year, if they come out of the winter and the energy situation is more clear, they'll probably hike faster, and that could actually give the euro some legs in 2023. But this year, I think it's moving very cautiously.
Stephen, you were talking about how supply chain disruptions have caused the people in the U.S. to worry about when they get their exercise equipment, but in Europe, worried about how to heat your homes. At what point does the U.S. start to experience something more similar to the European angst? And this goes to this idea of divergence, how far the U.S. economy can diverge from the European fate.
Well, insofar as it's related to a particular commodity, as natural gas, that divergence can extend for a long time. We might have to pay more for our energy, but we're going to have it. I think the European situation, if it's a very cold winter, and if the accommodation to increase supply doesn't occur, it could happen. It could be an extended divergence. It's not our baseline, but it certainly is a risk.
If there is an extended divergence, what does that mean for how disruptive dollar strength could become if it could escalate beyond where people are currently expecting?
Well, you're seeing different currencies react differently. Like, Aussie Kiwi last week, they've done poorly like everybody else, not so terribly. They don't have that kind of exposure. You have the yen that's done reasonably well. Again, they're benefiting from oil prices going down. The natural gas situation isn't as dire for them. I think it's horses for courses. And then you have a set of currencies like, Mexico, Brazil, some of the EM currencies where interest rates are high. So there's a buffer against Fed hawkishness. So I don't think, I think if the Fed is hawkish, it's going to be a broad dollar move. We think it's going to be limited. But, I think there are different, circles of currencies that will respond differently depending on their vulnerabilities and, in some cases, their strengths.
Steve, if you had to take a bet on the next 3% on euro dollar, higher or lower, weaker, stronger, where would you place it?
I think the risk is to the downside. But if you were asking me that question in January, I'd probably say to the upside.
Steve, awesome to catch up. Steve Englander of Standard Chartered. I think really putting it quite simply about the difficulty that Europe is in right now. Ed Yardeni Research published earlier this morning, and this is important. It's not just about the US economy holding on. It's about whether corporate profits will hold on in the face of what's happening in Europe. And he said this: a severe recession in Europe might not cause a recession in the US, but it certainly would depress the earnings of many US corporations. It would strengthen the US dollar further, which would also depress earnings of US companies with sales in Europe. Tom, that's the issue here, isn't it? Corporate profits versus what the economy will do.
It's at the margin in last quarter maybe, and I defer here to someone like Julian Emmanuel, where we were bailed out by strong nominal GDP, better revenues that mask that. But yeah, I agree, John. It can be a theme forward, no question.
Lisa, your thoughts on that?
Well, how much have we really gone through the secondary effects of a European recession and the divergence that causes not only dollar strength, but also weaker profits? To me, that I wonder how you game that out.
John, I'm absolutely dazzled, and you did so well with Liverpool, Man U, that I want to do Soccer Tuesday here with John, folks. I mean, the United Kingdom stops for Soccer Tuesday.
Thanks, Tom.
With John. And I want to go to Nottingham Tots like a week from now, a long ways away. And what I don't get
Sunday.
Is Nottingham has to play the Carabao Cup, whatever that is, and the Tots don't.
That's the league.
So they have to play an extra game in between.
I didn't know that, Tom.
That's unfair.
That's news to me. Thank you for sharing it.
is.
I'm reluctant to offer anything on football anymore, Tom. After my dark prediction for
they would never happen in the
United,
NFL.
Liverpool. It's going to last about a week, Bramo.
Really?
I'll keep it Jackson Hole focused into the weekend.
Soccer Tuesday.
The job to bring inflation back down to the 2% goal is far from accomplished.
We do have inflation softening. We figured that the peak happened in the second quarter.
If we're being intellectually honest, we have to set up for some choppiness and volatility through the end of the year.
It's going to be a little bit choppy, but overall, we're going back into a growth market.
Markets are not perfect. They're not always rational, and they just sometimes need to be given the alarm bells.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television, on the way to Jackson Hole. And John Ferro, the cliche is, it's August. This one's different.
It might be August, Tom, but it feels like winter in Europe already. Winter's arrived, never mind winter's coming. The PMI on manufacturing in the UK at 46, in the Eurozone at about 49. That's some really weak economic data already, Tom. And these central banks are hiking into it.
Open question. Markets on the move. Which data point matters to you, John?
Foreign exchange the last couple of days, TK. I think we're both on the same page on that front. Euro-dollar, can we get used to a euro-dollar?
No.
South of parity?
Nope.
At 99 and maybe a 97 if Matt Hornback of Morgan Stanley's correct, or 95 if Jordan Rochester over at Nomura is right. Tom, these are some big calls, and they don't sound that big anymore. We're just around the corner.
Governor Bailey will travel to Jackson Hole. It'll be interesting, that photo shoot as they waltz out of the lodge across the vast acreage of the Bloomberg TV set to the split rail fence, John, where they look upon the elk and the buffalo and the bison.
Sound on it, Tom. We need some music.
What are Powell and Bailey going to talk about?
TK, what are they going to talk about?
What
They've
are
got
they
to talk
talking
about the
about?
fact that they need to get inflation under control. I think we've sort of lost vision of the numbers we're talking about. I lost an understanding of them. City's talking about 18% on inflation in the UK in January. I don't think we even know what that means, 18%, and the second-order effects around numbers like that, Tom. It's ridiculous. And when I talk about natural gas in Europe up more than 40% in a single month and taking out the spring peak, the chart's gone vertical in the last couple of weeks. I don't think we've really fully understood, Tom,
Lisa,
fully realised what that means.
What to me is fascinating here, Lisa, is we addressed with Jan Hatzius, this is a Jackson Hole of the haves, and they better focus on the have-nots crushed by 18% inflation.
Which is the reason why the message is going to be hawkish. That is the consensus right now, because the Fed cannot go out in good conscience and say that inflation where it is okay, when it is crushing, in your words, the lower income families. And it has been, Tom, pretty consistently. How high they can hold those rates, though, to me is the key question. If they go to 3.5%, as Jan Hatzius was saying, and then they hold it there for a couple of years, what does that say about how much resilience is in the U.S. economy and what that does to completely rejigger financial markets as we have gotten to know them over the past few decades?
John, Jamie Dimon just emailed in and said, Tom, shut up and get to Phil. So we're going to do this quickly on the data up front. John, I'm going to look at the equity market, a rebound off the Dow, negative 600 points yesterday. Dow futures right now, John, up 46
Thanks for
points.
that, Tom. I'll let that one go. Futures up 0.2 on the S&P, on the Nasdaq up 1/3%. What did you do, Tom, yesterday? Posted a picture of James Milner shouting at Virgil van Dijk, and I was James Milner and you were Van Dijk, and I was screaming at you not to quote the Dow. Did you see that yesterday?
The Dow matters, John. The Dow is the emotion, the signpost
the Dow
for
matters.
America.
Okay, get to Phil.
Let's do the data here. We'll do it quickly here. Oil, I'm going to save us with a rebound, $92 on West Texas Intermediate, Brent, $98 a barrel. Philip Camporiel is portfolio manager at JP Morgan Asset Management, but far more from Mary Airdros. He synthesizes the JP Morgan view. And at the bottom of the research note, Phil, it's real simple. You say America's the place to be.
Yep.
State the case for an enduring investment scene in America.
It's probably the more resilient economy to the G4 central bank hiking that we've been talking about for the past couple of minutes. Also, if you think about Friday and how much is at stake for Friday, I think Lisa's right. They're going to talk hawkishly. But as far as what we have to do, which is invest in the capital markets based on incoming data, I think the notion that markets have to move a material amount based on comments on Friday, we think is misplaced. So why is that? One, 10-year treasuries are back to 3%. That's one. Two, there is not imminent easing priced in anywhere. There's 100 basis points of tightening priced in between now and the end of this year, and 140 basis points of tightening priced between now and the first quarter of next year. Also, if you think about how difficult this year has been, it's been because there's been nowhere to hide. Fixed income has been a very tough place to manage downside risk. We think those days are over. Why? Because gas prices down 20%, Tom, from June. That's not the only thing. You have airfares down. You have owner's equivalent rent, which is staying firm. But the biggest drivers of inflation, we think, are headed in the right direction. And more importantly, the tips market is saying the same thing.
Okay, but John, you got to add, too, that the Yankees are down as well. I mean, that's a bigger surprise
you brought that
than
up
oil.
early in the conversation. I thought we'd wait until the end, Tom. We'll let that go just briefly. Phil, if that's the case, where's the leadership come from in the equity market?
Yeah, so the leadership in the equity market, we think, comes from the growth parts of the market that were completely beat up this year with rates. And just to throw another Yankee reference in here, if Yogi Berra, the great Yogi Berra, it's not over till it's over, if he was talking about the fixed income markets, he'd be saying, just because the Fed's raising rates doesn't mean rates need to rise. And why is that? It's because fixed income is back to where it should be as a ballast in a portfolio. And if you're investing in the equity market, okay, I think there's more comfort now that fixed income could be that defense, which was very different from what we saw in the first 6 months of this year, John, when the Bloomberg aggregate index was down almost 12% at the worst point. John, the worst year ever for the ag was 1994. Okay, and we were down 2.9%. So I think the environment for investing looks so much more supportive than it did in the first 6 months of this year because of the sheer fundamental ability to manage risk, which was missing for most of this year.
So Phil, just to sort of underscore your point, are you saying that people who think that markets have gotten ahead of themselves and that financial conditions have loosened too much for the Fed's comfort have gotten way too cute about it, and that this is okay, that the real easing that we've seen in financial conditions through the rally in equities, through the rally in bonds, is just fine?
Yeah, I think so, Lisa. I mean, you had financial conditions as measured by the Goldman Financial Conditions Index, obviously off the tights. However, they should be off the tights if inflation peaked in June, which is our hypothesis. You can't overstate, Lisa, the effect of gas and commodity prices and how much pressure that takes off the Federal Reserve. Now,
so trading the peak is one thing. I just want to jump in. What do you think we're coming down to? Down from 9 to what?
Yeah, so we're at 8.5 now. By the end of next year, 2023, if the tips market is right, if our forecasts are right, you're between 2.5% and 3%. Heading in the right direction. Now, John, that's why there's 140 basis points of tightening still priced in. There's no victory declared here from the Federal Reserve. I just want to be clear. They will continue to tighten. We just don't think that the pressure of them becoming more and more hawkish for every meeting is the same as what it was in those really chaotic and frenetic moments in asset markets in June.
Phil, let's say that Jan Hatzius at Goldman Sachs is correct and that the Fed does not necessarily raise rates as high as some people have feared, but holds them at 3.5% for a prolonged period of time, possibly years. How does that change your narrative? How does that change your thesis about growth equities?
Yeah, that sounds like a really resilient economy, actually, Lisa, to us. If they're not imminently easing, by imminently I mean in the back half of 2023, that means that this race between inflation rolling over or growth rolling over is won by growth and the resiliency of the U.S. economy. And I think if you look back at the last cycle, Lisa, even if you have trend growth or a little bit below trend growth, like we saw in the last cycle, that's a really supportive environment for growth stocks. Even if you have a flat yield curve, that's a good environment for growth stocks. What you can have is a revisit or a retest of that anxiety from early in the summer when commodity prices were spiraling inflation out of control, which puts a ton of pressure on long duration equities or mega cap growth stocks. So Phil, it's still in a supportive environment.
Before we go, you can squeeze in the Yankees. Take a dig at the Red Sox if you want.
Not the Mets.
Yeah, and as Lisa's right, it's not the Mets, but the Red Sox are still in the rearview mirror, thank goodness.
That's a good thing. TK, anything to say on that? You're going to let that go?
My childhood was one of a rearview mirror. It's very important to understand.
Talk about
Red Sox
Phil.
didn't win.
You said Lisa and I needed a therapist.
I mean, seriously, like my childhood.
Phil, thank you. Phil Camporelli of JP Morgan Asset Management. It's okay, Tom, to feel vulnerable.
I get emotional.
Share your feelings.
It's been a brutal year.
for Red Sox baseball.
Yeah, I feel Frank Malzone was our third baseman, and we had Ted. That's all we had.
What are they doing,
Dick
Tom?
Raditz.
Not good for the Red Sox. Not good for Liverpool.
They're rebuilding.
Mr. Henry's having a tough year.
Yeah, they're rebuilding.
Okay.
I don't know.
All right, let's get to the market. We'll let that go, Tom. You take a beat.
Futures
up.
I'm unfocused.
By more than 1/10% on the S&P, on the Nasdaq up by 1/4%. The essence of what Phil's saying here, I guess, is that we go back to the old playbook.
Yeah.
Bramo. Rates will have to climb a little bit more, but ultimately they're looking for inflation to fade, and growth equities is where the leadership comes from. Dan Suzuki of Richard Bernstein on the show last week, pushing back against that.
Well, also PIMCO pushing back against that, and Capital Group, a number of big fixed income investors who say that this inflation is different. It has a stickier feeling and it has a longer shelf life because of some of the structural changes with reshoring, with onshoring, with deglobalization, or perhaps a shifting globalization. How does that fit into his thesis of rates not having to rise even if the Fed raises rates, right? That we can go back to what we have once known.
What do you think the GDP price is that you need to pay to get inflation back down to 3%?
Well, this is the other thing, and a lot of people are saying that it's got to be pretty significant. That's the Bill Dudley point. That's the Larry Summers point, saying they have to be honest about the pain that the economy has to suffer. A lot of people disagree.
It's a toxic brew, Bramo. It's a toxic brew.
It's always a toxic brew,
It's a toxic
especially,
brew.
Toxic brew of Tang.
Pretty brutal out there. Doing okay, TK? It's all right.
I've lost focus. Phil's just crushed me here with the Red Sox.
It's coming up very shortly. Gas prices in America, should say gasoline prices
there you
in
go.
America,
Love it.
down for 70 straight days.
Amazing.
70 straight
John,
days.
Can I opine?
Please, you've got 7 seconds.
Watch Sterling. I would watch Sterling like a hawk.
Thanks for sharing.
Thank you.
From New York.
I need a Narragansett.
This is Bloomberg.
Would somebody get me a Narragansett?
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. And sticking with that story, gasoline prices in the US have now fallen for 70 days in a row. That is the most in more than 7.5 years. According to the Auto Club AAA, pump prices are averaging $3.89 a gallon. That is after reaching what was a record high of around $5 in mid-June. There are signs that fears of a recession in Europe may be coming to pass. Economic activity in the Eurozone fell a second month. August drop was driven by manufacturing. Still, the post-lockdown rebound in services like tourism almost ground to a halt. Consumers have been hit by big jumps in both energy and food costs. The U.S. government reportedly has recovered more than 300 classified documents from Donald Trump since he left office. According to the New York Times, that includes papers returned in January, a second set given to the Justice Department in June, and the documents seized by the FBI at Mar-a-Lago. The Times says some of the documents came from the CIA and the National Security Agency. In Malaysia, former Premier Najib Razak will serve a 12-year prison sentence after losing his final appeal in a trial linked to the multi-billion-dollar 1MDB scandal. The court ruling will prevent Najib from running in elections that must be held by September 2023. Macy's has cut its profit outlook for the full year. The guidance missed the average analyst estimate. Still, the department store operator also posted second quarter earnings that were better than expected. Like its peers, Macy's is contending with shifting consumer preferences and shrinking budgets at a time of decades-high inflation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're talking about households seeing a quintupling in their energy bills. A normal household paying, over £1,000 a month for electricity. It's a shock that is not going to be able to be absorbed.
This Jackson Hole promo is killing me. If I don't arrive at Jackson Hole Airport on Wednesday evening without that music playing, Tom, and if you're not there ready to pick me up on horseback to take me to the hotel, I'm going to be very disappointed.
Well, we've done the horseback thing before years ago. We did that. It was around 2007.
Really? To transfer to the hotel.
McKee and I, we went up. McKee and I went up. And this is coming out of the Jackson Hole Airport, and you go north up the Jackson Hole Valley. You get like a third of the way, halfway to Jellystone National Park, and Idaho's on the left, and it's all beautiful in that. But we did the horseback thing, and we were tired by the time we got there.
It didn't work out.
That's just a lot of work,
I just heard there's some budget cuts for this one, Tom. So maybe we do horseback to to the hotel from the airport. Just something to think
from
about.
There, you know. Right now, our interview of the day, as we keep you informed, as you did with Stephen Englander of Standard Charter on the currency market, to drift away from the real struggles and agony of Europe and hydrocarbons. Stephen Shork joins us, principal at the Short Group, here on what has been unspoken. Natural gas is a moonshot in America as well. Steve Shork, there is the spread out into March and April called the Widowmaker spread, which is the guesstimate of how low inventories will be. How low will inventories be when the Widowmaker spread matters?
Yeah, absolutely. This spread is the difference between gas delivered for the final contract this winter, approaching winter, and the first contract of next summer's refill season. And that spread right now in the month of August is trading as if we are in the dead of winter. It is a clear signal that the market is betting that we are going to be short gas throughout this entire winter, which is a problem because at the current rate, we're entering winter with stocks at about 200 BCF below normal, well below the EIA estimate, which is 3.43 TCF, and well below the 5-year average. So going into the winter, stocks very low. The back end of the spreads are telling us that stocks are going to remain low, which is going to be a problem for our winter heating bills because not only has natural gas prices tripled over the last year, but two oil stocks, heating oil stocks here in the Northeast, in New York Harbor, are 20.5% below normal, 3 million barrels below normal, which is going to be a problem for people who heat their homes with oil, primarily in the Northeast. So as we look ahead, the spreads are telling us the market is short product, winter product, and hence higher bills this winter.
Are we going to run out of jet fuel? I mean, what's the use of fuel in the Northeast? I know it's a heating oil region and all that, but like, are our viewers and listeners supposed to say, OMG, it's going to be like Europe?
Not quite like Europe, but we're certainly setting up the dominoes to be like Europe in a couple of years. Of course, that translates into natural gas. And right now, as we know, Europe is very short natural gas, primarily because they put all of their eggs into the basket of a tyrant. And that tyrant now is keeping supply short. That supply gap is being filled in part by U.S. LNG. But back at the start of the summer, we had a export facility that went down, which accounts for 20% of U.S. exports of natural gas, which primarily were going to Europe. Now, that facility is going to come back online partially in October. So that's going to be an even further strain on U.S. inventories going ahead because the ARB, right now, European gas prices yesterday traded the equivalent, check this out, the equivalent of $470 barrel crude oil. So if you can export natural gas, you are exporting everything you have right now.
Let's get Lisa in here.
Well, but Stephen, that's exactly where I was going to go because this was actually when the Freeport facility went down, that actually lowered prices in the U.S. And when it goes back up, people are expecting it to cause prices to go up because of what's going over to Europe. Are we pricing in a full seizure or a full closure in terms of the Nord Stream 1 pipeline and the liquefied natural gas flowing from Russia to Europe?
Yeah, to your point, yes, it's an excellent point. And that is, I do believe, part of what is happening in that back end, that March-April spread. I want to put a caveat out there, though. That March-April spread is probably the most liquid spread in any commodity market, highly traded, highly speculated on. This was the spread that blew up a $9 billion hedge fund, Amaranth, back in 2006 because they were playing games with it. Traditionally, mathematically, statistically, what you tend to see is the March-April, the March contract tends to lower, get weaker relative to the April contract as we go through winter. So we should keep an eye on that. But right now, the front end of the curve is trading as if we are in the dead of winter, and the back end of the curve, because of your points with regard to the lack of supply, both here in the United States and the drain that we'll see because of Europe, is keeping that back end of the spread very high. And which means we're going to see high winter heating bills and likely high next summer air conditioning bills because natural gas is such an important feedstock into electricity generation.
Stephen, just quickly, I saw the headline from OPEC Plus yesterday from the Saudis. I had no idea what they were talking about. Can you just digest that one for me and translate it? What were they saying?
Absolutely. So what the Saudis were saying essentially is there's a major disconnect in between the physical market, the actual market that they trade, and the futures market, the paper market, which again is very high in speculation. So the futures market has been very low relative to what the Saudis are seeing in the physical market. So they came out yesterday with a pretty hawkish view, which sent oil prices screaming higher, that they might actually have to cut production, which really caught the market off guard. But, you know, interestingly enough, that headline came out about 2 hours after all the headlines were breaking that the West is about to make a deal with the Iranians on very favorable terms to the Iranians, which, again, the Saudis are not very happy about. So you tend to see a bullish or a hawkish headline coming out of Saudi every time you hear a dovish headline coming out of Iran. So it is a game of push and pull on the geopolitical front.
Stephen, just quickly, I've got 30 seconds, but it's so important. I never know what to do with those Iran headlines. What do they actually mean? How close are we to a deal? I feel like we've been doing this now for months.
Yeah, we have been doing it for months. And my concern was that the administration, because they're in dire straits with regard to the midterm elections and high energy prices, they were going to strike a deal with Iran. I'm still skeptical. You know, maybe it's a little bit of hope that we don't reach a favorable deal because given where Iran's geopolitical intentions are, not a good step to keep on putting money into their state coffers right now. Yeah. So hope, but probably we'll see a deal.
Stephen Shaw, thank you, of the Shaw Group. Really I find all of this very, very difficult to understand, Tom, and piece together.
We got this out of the archives, the surveillance archives. This is a great image of Kathleen Hayes and Michael McKee moving from the airport, and they're up past Moose, Wyoming here on Beaver Creek on their way to Jackson Hole.
Were you driving?
Kathleen, she's driving.
Oh, she's driving. You weren't.
Yeah, she elbowed Mike and said, I'm doing it. No, I wasn't there. I'm afraid.
Do they have surround sound so we can play that music?
Yeah, the music goes with it.
Live from New York, good morning to you. Futures positive, 1/10% on the S&P. On the Nasdaq 100 up, let's call it 0.2%. Yields higher by 3 basis points, 3.0. Let's call it 3.05% on a 10-year. And if you look at foreign exchange, the dollar stronger again against the euro. Euro weaker, fourth straight session of this. 99.20 on euro dollar, Tom.
John, we need to color that and say there is a weight to this. Like this bid happens, you get a little pop and you come right back.
And we saw that yesterday, Tom. We're down a few tenths of 1% on that currency pair. And then I think by the end of the day, we had a move of almost 1 full percentage point.
For those keeping score at home, I would also focus on dollar yen 137.50 for what it's done, which is it hasn't moved. If yen was to give way 138, boy, would that change the dynamics a lot. Exceptionally strong set of conversations today. Jan Hatzius of Goldman Sachs joining us, and we continue strong now with Stephen Risciuto. To say he's chief U.S. economist at Mizuho Securities barely describes their desk. With Dominic Constant, Stephen Risciuto folds in a massive macro view, including a calculus of GDP in America. Steve Risciuto, when you talk to Dominic and the two of you get together, are we in recession?
The NBER will not classify it a recession. To me, 2 quarters of consecutive negative GDP reports, implies you're in a recession. The problem for people is going to be that this is going to be a very shallow, very long recession. It's not going to be the typical recessionary environment that we've seen since 1990, which were credit cycles, nor is it going to be the typical inflation cycle that we'd experienced in the post-war period up to the 1990s. It's a very, very different cycle. It's a long, shallow cycle.
Right. Well, within that, and this has been the theme for the day, Steve Risciuto, if you have a long, shallow cycle, does that mean the real message from Powell at Jackson Hole will be a more sustained view of interest rate strategy and not the foolishness of when do rates come down?
Oh, that's exactly been our call all along in here, that we were basically looking at a dynamic of a pause, not a pivot. The question that we're still debating, is it 4% or is it something north of 4%? I think we have to get to at least 4%. And last time I was on, we were talking about it. We were pricing 3.5. Now we're pricing something in between the 3.5 and the 4. I think we'll get to the 4, and hopefully that will be the end, but it may not be the end of this scenario.
This is the raise and hold debate, Steve. We caught up with Jan Hatzius of Goldman. Take a listen to what he had to say.
Where I would disagree more with market pricing is the pricing for significant rate cuts. I think it could be a couple of years. I mean,
Really?
if you get to the mid threes or maybe even a little bit higher, and then you stay there, because I think while inflation will look a lot better a year from now, I think it'll still be significantly above the target.
Raise to what and hold for how long? Raise to 3.5% and hold for a couple of years, Steve. What do you think of that?
Well, I think we're going to keep on moving higher than that. I don't think 3.5 is the top, and nor do I think necessarily we're going to hold it for several years. I think there's clearly an argument to be made that we're going to hold it through 2023, but where we go in 2024 is a very, very different animal altogether, because you have to look at what's happening in the currency, and you have to look at what's happening with supply chain related issues, and then you have to look at the demographics in the labor market environment, and it's this tug of war that we're going to see from a stronger currency, supply chains easing up, versus the wage-related pressures that are being dominated by the demographic issues, in particular the reduction in the number of workers from the millennials to the Generation Z, which is now entering the labor force. So we might wind up in an environment where the Federal Reserve has to sustain higher rates on a longer basis than we've seen in here for quite some time. But again, what the starting point is still an open book.
What's the advantage, Stephen, for the Fed raising rates beyond 3.5%? What's the end target and why, especially if they plan to then take them down to something lower over a longer term?
Well, again, do they plan to take it down to something lower over the longer term? The real question is, how does this labor market dynamic play out? You can make a very, very strong demographic argument that the labor market stays tight throughout the entire period in here, and therefore you are in a sustained higher level of interest rates going forward. The question always is going to be, what level of rates will that be sustained at? But a quick return back to the near zero interest rate environment that we've been anticipating or that people have been somewhat anticipating, is going to require some kind of credit event to unfold in the economy. And when you look at the underlying credit quality of the economy in general, there are some pockets where we are concerned, but in aggregate, the balance sheets are still very, very healthy.
So what is your top Fed rate that you're kind of penciling in here? How has that evolved over the past few months?
Well, it's evolved a lot, over the entire period of 2022. But I do think 4% is the near-term target. And I think once we get to 4%, we will pause for a time. Whether or not that's a pause to go higher or a pause to continue to hold that level on an ongoing basis, that's where my thought process is.
Steve, inside baseball, if we've got China with subpar China growth, the dynamic of exports minus imports, how does that change, and what does that mean for Chairman Powell?
Well, again, that comes right back to the currency story, because it's the supply chain dynamic. You have a slower global GDP environment. Clearly, what's happening in Europe is creating a wider GDP output gap globally. You have a strong currency, which will allow us to import those products on a more competitive basis, which will wind up dampening domestic inflationary pressures. And then you wind up with, where does the services dominate over the goods portion of the equation? And I think this is the reason why inflation is going to come down. Whether it'll get as quickly as the Fed would like to see back to their target or not, I think it'll get there. I think it'll get there probably in 2024. I don't think it'll get there in 2023.
Steve, my first exercise this morning was to look at the Bloomberg Financial Conditions Index for the United States and for Europe, and to note back over 30 years that this is the first time they've diverged so sharply. Now, obviously, there's a war in Ukraine, which is dealt to this. What does Bailey say to Powell, or Powell say to Bailey, on this immense transatlantic divide?
Well, I think the situation is the reverse of what we experienced in the 1970s, where the Federal Reserve Chairman at the time, Paul Volcker, came back from an IMF meeting and was forced to change monetary policy abruptly and caused one of the worst macro recessions, inflation recessions we've seen in our history. And I think all of the problems on the currency side of the equation are really European problems. And Europe has to address its issues. We can't fix it market's problem for them. And that's pretty much the same message that, Paul Volcker got in reverse when he came back from the IMF meeting in 1979, which was basically, you have a problem with your currency. That's why your currency is going down. You have to fix your problem. And I think Powell has to push it right back on them. You've got a problem. You have to fix it. We can't fix it for you.
And this is the different kind of FX war, Lisa, we've been talking about through much of this year. This is a big problem for Europe. And it's kind of strange because 10 years ago, this is exactly what they were trying to engineer, a weaker euro. They couldn't get one. They couldn't buy one. And now they've got one, a dramatically weaker euro at a time that they arguably don't want one.
Absolutely, importing inflation. How much, though, is this also a problem for the U.S.? And we haven't really talked about that, John, but this was something that you had discussed earlier in terms of the Ed Yardeni note, which is how much of a pressure will this be on the balance sheets of companies that sell into Europe that have to deal with the headwinds from a stronger dollar? I don't think people have gamed that out sufficiently.
Well, the multinationals are going to have a problem, aren't they? But that's a corporate profit story, what it means for the broader economy. The other issue that we've got here as well, Steve, Tom asked an important question. What does Governor Bailey say to Chairman Powell? Governor Bailey is seeing economic weakness right now in a more pronounced way than Chairman Powell is. And Governor Bailey hasn't seen the year-over-year peak in inflation. You've got him forecasting something close to 13%. You've got Citi saying it might be 18%. Steve, isn't that the bigger difference right now? The transatlantic divide is that the US may be able to take some very, very small amount of comfort from this idea. We might have seen peak year-over-year inflation. For Europe and the UK, is it still in their future?
Well, again, this comes down to the fact that you remember the way we broke the back of inflation here was not just a monetary policy scenario. The supply side revolution failed in terms of many things, but by breaking the back of labor through firing air traffic controllers, we did a lot in terms of changing the labor market dynamic, which was our problem back then. So again, you have to push the blame back just not on central bankers. Central bankers have to push blame back on politicians and say, you have to correct what you've done from a policy standpoint that has put us into this position, and it is your responsibility now to take the steps that are necessary. You can't expect central banks to solve all of the world's problems.
Steve Rasciuto of Mizuho. Steve, thank you, sir. Looking ahead to an important meeting later this week in Jackson Hole, Wyoming. Governor Bailey will be there, Tom, Chairman Powell. Who's there for the ECB, Lisa?
Schnabel.
Schnabel.
Yeah.
Looking forward to that as well. I think we're going to hear from all three at some point, Tom.
It's going to be, I don't know what to make of it, John. I just think if the market is here, where is sterling? Where is euro in 24 hours? Where are they in 48 hours? You're going to tell me that they're going to have a normal dialogue with a 116 pound? I don't think so.
And a 99 euro dollar.
98,
We came close this morning, sure.
I don't want to oversell it. I don't want to hype it. I mean, just,
I don't think you are.
You and Lisa on a wagon train alone is enough.
Okay, you're overhyping
to hype
that.
in it. But it's John, you get north of Moose, Wyoming, and the bugs get less.
Okay.
You get into some of the glade by the southern part of the lake.
I don't know.
Like it's the black flies.
The bottom line here is we're teeing ourselves up for some market moves in 4 days. It makes his speech possibly more interesting than we ever thought.
The FX channel is tremendously important because, as Lisa said, you're importing inflation. Arguably, you would want a stronger currency. Europe and the Bank of England and the ECB, they can't buy one right now. And the complication, the added complication, it gets really complex when you think about it this way, is can you guarantee that a larger rate hike from the ECB or the Bank of England would actually lead to a stronger currency? Or are we now just trading growth differentials, Lisa, because it would hammer growth?
That's what a lot of people seem to say, because right now the weakness does not have anything to do with ECB policy. It has to do with the ramifications of a natural gas price that has surged more than 100% in the past few months.
This was fun. We'll be talking about horseback riding, counting you down to the opening bell. We won't. We won't. Emily Rowland of John Hancock Investment will be joining us. George Bory of Allspring Global Investments and David Leibovitz of JP Morgan Asset Management to guide you through to the opening bell.
Can you do this, John, like where you're lassoing? You're swinging the lasso
I can't do that, Tom. Can you do that?
I can't do that, but then I can't hula hoop like you do.
I'm a good hula hooper.
I'm not.
Why would I be a good lassoer?
I don't know. From some of the stories I've heard, John.
A lassoer. Is that no? Not a word? Not a word.
I don't know.
When I was a kid, all I wanted to do was dress as a cowboy.
It's like petrol.
That makes so much sense.
4 years old and wanted to go to my auntie's wedding in Italy dressed as a cowboy. It meant the world to me.
Pictures.
John,
please.
you'll have the
Wasn't allowed. They
opportunity
would not
to
let me
dress as a cowboy on Thursday.
Can I dress as a cowboy Thursday?
Yeah.
Without offending people.
Chaps, spurs.
Relive your childhood dream, John.
I think that the people of Wyoming are less prone to being offended by things like that. I think they've got a high tolerance level.
The rest of the world, not so much.
They'd welcome it, maybe. Futures unchanged. They didn't welcome it in Puglia, in the south of Italy. It just wasn't allowed. What are you doing down here?
Dr.
On-air therapy?
Well, I think we've got,
Dr.
we were
Bramwell.
going to first word news, but given the 60 seconds left on the clock, I'm not going to do that to Michael Barr and Ridika Gupta, Tom. Let's go a little bit longer. We've got about 50 seconds if you want to fill it. You've got things to say?
I got pivot,
What's your pivot?
I got pivot. I'm sorry. The gloom is out there, and I'm listening to the bulls, trying to discern what the bulls are saying.
Well, I've given you the bullish view from Marko Kolanovic over at JP Morgan. He thinks
that's one view,
but
but
this inflation
Julian,
story will just
Jonathan,
ease on its own,
and
that China will pick up and things will get better.
I think there's a set of maybe we could use this music.
What I would like tomorrow is the music used on the promo to go out to the breaks with.
I like the music. They just keep playing it, hoping that we'll stop. We're not
I'm going to stop in 10
Look, I voted, John.
I hit my mark.
John, for the music for the Jackson Hole, I voted for Nickelback. I got nowhere.
No.
Maybe Flying Burrito Brothers?
Okay. From New York City, this is Bloomberg.
We had the choice of backing a brilliant car designer by the name of Henrik Fisker or an ambitious, slightly crazy entrepreneur by the name of Elon Musk at Tesla. Well, we made the wrong decision, but Tesla did very, very well, and so did electric vehicles.
One of the most interesting and one of my most favorite people on the planet. His name is John Doerr. He's chairman of Kleiner Perkins, the author of Speed and Scale. It is a conversation with David Rubenstein. I really can't say enough about that. Look for that tonight at 9 p.m. Lisa Abramowicz and Tom Keene with Mr. Rubenstein now. On a guy, David, John Doerr, Intel was 3,000 employees when he joined. It's now well over 100,000, even with the challenges that they have. And what I find so interesting, David Rubenstein, is this is a guy that's lived the boom of the Young Turks of Silicon Valley, and now they have to make a generational shift. What did he say about the challenges of a generational shift in our tech wonders?
Well, he did incredible things in the internet era, and he was an early backer of Google and an early backer of Amazon. And as a result of that, he's been able to make recently the largest gift in Stanford's history, $1.1 billion to create a sustainability school. And that is the result of his very smart investment decisions during the internet era. Now he's focused on climate change, and that's his sole investment focus as well. He's giving a lot of money philanthropically there, but also he's now making investments in all kinds of companies that are likely to have some impact on climate change.
What is he saying about the people that literally he birthed? I'm absolutely fascinated. The shift at Amazon, the shifts at Google, and on and on. How did he address this generational challenge of people who think they're different than Colgate-Palmolive or John Deere?
Well, clearly people in Silicon Valley who get money from firms like Kleiner Perkins, John Doerr's firm, obviously have large egos and think that they're going to change the world. In some cases they do, in some cases they don't. He's unusual in that he really spends an enormous amount of time trying to figure out how he can help these companies. He doesn't just give them money, but he's willing to work around the clock to make sure these companies succeed. And that's what he did with Amazon and Google and had a big impact on them. Now he's doing the same in the climate change era. And I would say that he was motivated to do this in part because when his daughter, one of his two daughters, watched Inconvenient Truth about the climate change problem, his daughter said to him, your generation screwed up this country and screwed up the world. What are you going to do about fixing it? And so it motivated him to actually do something about it. And now that's what he's really dedicating the rest of his life to do.
Over the past year, we've seen a little bit of a reversal in some of the efforts toward the greenification of the energy supply. We've seen a reversion back to coal, fossil fuels in the wake of some of the shortages and the Russian invasion of Ukraine. Did he talk at all about the willingness to invest even more at a time when there is more of a question about the importance of fossil fuels and not discounting them?
Well, his view is we don't really have a choice. Right now, the planet is not going to be able to be survivable if we don't make changes in the way we generate energy for people on the face of the earth. So he doesn't really think there's a choice. He does recognize that because of the war in Ukraine, many people have probably said, well, climate change is something we can worry about in the future, and we don't have to worry about conversion to renewable right now. But that's not his view. He thinks it's more urgent than ever, and he has a very elaborate plan how we can convert our efforts now and using energy from carbon to renewable sources, and he's quite passionate about it, and that comes through in the interview.
The passion versus the profits, and that has been something that a lot of people have been trying to discern, especially with the ESG focus that hasn't always delivered in terms of the returns. How does he sort of parse this out? I understand the ideological drive that he has towards some of these causes, but where does he look for the returns to come?
Well, remember, he's looking to back small companies that are going to grow into the Amazons and Googles in the climate change area. So when he backs a company, it's going to take 4, 5, 6 years or so before it might be apparent whether it's going to work or not. But he thinks we really don't have a choice because if we keep doing what we're doing, ultimately the planet won't be survivable. And so he's very passionate about it, more passionate than he probably was about the internet.
David Rubenstein, in the day-to-day grind of David Rubenstein over the years, why doesn't Europe have a John Doerr? Why doesn't Asia have a John Doerr? And of course, the backdrop here is a debacle of SoftBank. But why is it just about America that we have a John Doerr?
Well, clearly, America is more entrepreneurial, I think, than Asia and more entrepreneurial than Europe. We have a much more bigger venture capital world than either Europe or Asia. And I think John Doerr is the personification of what our venture capital world can do. It has a very talented people who've been trained as engineers, as John Doerr was, but now are committed to doing other things. And you know, John Doerr is probably the best known of the venture capitalists in the United States right now because of his success over the years. But there are many other people like him, and you're correct in pointing out there aren't similar people, or not very many of them, in Europe or in China.
David, thank you so much. Congratulations on this important interview tonight,
Thank
9
you.
p.m. David Rubenstein with Mr. Doerr of Kleiner Perkins. Really looking forward to that. Moments ago, Steve Rasciuto's colleague Dominic Constam has published at Mizuho. I'm going to call it a pre-Jackson Hole note. And Lisa, Dominic Constam doesn't mince words, rather, within the dynamics he's always looking at. Is this a Fed that will further front load, or is this a Fed that will find some form of steady state? That's the debate.
And it's hard to know. He talked about the less euphoria for now as people await what's going to happen at Jackson Hole. You love the Fed gaming out system, which we've been trying to go back and forth on. But the longer term run rate is the important thing. And that's why he's looking at break-even rates. Tom, how much are people looking at a Fed that can get much beyond 3.5% still to that 4% level of his colleague Steve Rasciuto versus that they have to pivot, right? I mean, at what point do we see that terminal rate being unsustainable versus something that's needed for the inflation that we have?
At least I haven't asked this question. It's Ruinous. It's late Tuesday here. What is credit saying about this debacle of the last 2 days? What is IG saying?
Well, I know that in high yield, they've had a really miserable couple of days, and you've seen a pretty significant sell-off in high yield. In investment grade, it's held in a little bit more because there has been this pivot to higher quality. But there is a concern, and this is what we were talking with Winnie Caesar about. Perhaps there's not going to be the default cycle of yore. However, if you get benchmark rates that present an alternative, then what is the argument to go into leveraged companies at a time where Dominic Constam and frankly Steve Rasciuto were saying we could see a prolonged recession?
Yeah.
What's the argument then for over-leveraged companies that have to grow into their capital structure? It becomes a lot more difficult to see.
Major shout out here as we get ready to go to Wyoming. Qantas last night, we had a phone call as we were down Dow 600 points, and the team blew up the show today to give you the best in conversation with Stephen Englander of Standard Charter and Dr. Hatzius at Goldman Sachs, among others. Let me do a data check here to stagger into the 9 o'clock hour. We had green on the screen, a nice elevation. Now red, futures -2, Dow futures -24. The VIX gives me nothing, 23.82. 210 spread, very importantly, disinverts 27 basis points, well worth watching. The story in foreign exchange, the frontline DXY index 107, 108, stronger dollar, 109 right now. Euro a 0.9926, sterling, Ferro's broke. Stay with us. This is Bloomberg. Good morning.